or pushed back. There's all kinds of confusion around the different terms being raised. I would say that both vehicles were always planned to be on the same platform right now, and so we have to wait to see till August 8th. In our view, they could both be announced at the same time and shown at the same time as well, and that could be a catalyst for the stock.
Ben, is the bulls and the bears, is the thesis on each side basically divided on who believes in Elon Musk and who thinks he's just a man with a number of good ideas, but in this case, this is a car company?
The question always is it a car company? Is it a tech company? Is it an AI company? Is it an energy company? And, my answer is yes, all of the above. Right now with results and the auto industry, EVs in particular in the U.S., having weakness, Tesla deliveries in particular having weakness in Q1. We think Q2 numbers likely too high on deliveries. It comes back to being an auto company and not getting any real credit for the work that they're doing in AI, the work they're doing in full self-driving, and definitely the work that they're doing in energy, which is showing up in results, albeit a smaller part than the auto business. So right now, people are viewing it as a car company. That's the biggest risk to the stock, is it starts getting valued as a car company.
What in actual production right now gives you confidence that it's something more, that there's going to be a turning point given all of the bearishness and the fact that we have seen its value fall below $500 billion for the first time in a long time?
A couple things. Number one, I think being able to attract the best talent and engineers out there. In many studies, SpaceX, Tesla is listed, top 5 of being able to attract talent. Number two, the capital that they've been deploying, not just this year, but last year, the balance sheet they have to do that. Even, with the weakness, we still expect them to generate free cash flow after deploying $10 billion in CapEx. I think a big chunk of that is going to AI and different initiatives there. And so, as they, discuss the different waves of growth, the next wave is going to take longer. And the risk also is we have kind of a flat to downish, 3 years in a row, and people start wondering, is this a growth stock? And I think we have to be patient for that longer term, 26 plus.
Ben, I'd love to ask you about the industry more broadly. I spoke to the White House climate czar yesterday, John Podesta, who admitted there's still some range anxiety out there because of the lack of EV charging stations. I think it's about 16 EV charging stations for every single gas station in the United States. Until that gets fixed, are we almost at peak when it comes to EVs?
Well, the U.S. is lagging China penetration. I mean, I think if you look at the China numbers, just in Q1, up year over year, over 30%. U.S. still growing. A lot of headlines suggest that there aren't growth in EVs. There has been a lot of pullback from the other OEMs. Ford, GM, still committed. Different timelines pushed out. At the bottom of it, though, Tesla's been very aggressive on expanding their supercharging network and opening it up to other OEMs, because it's still a problem out there. So often you can go to non-Tesla charging stations, they'll be broken, there'll be a long line, technology's not that great. Tesla's really leading the way in the U.S. in this, and I think that the work they're doing now will help with adoption in the future for not just Tesla but other OEMs as well.
Do you think we can ever see Tesla produce a hybrid?
No, I don't think so. If you look at the data here, and there is a consumer shift to these plug-in hybrids. One, just personally, driving one as a rental car, inferior product. It's inferior to a internal combustion engine. It's inferior to a pure EV in the way it drives. Number two, if you think about it from emissions. And we don't really highlight that as much as maybe we should, but the emission profile is much worse than a pure EV. A lot of times people don't charge them, so they're just running off of gas.
Yeah.
And so there's a lot of data coming out now out of the EU and other places showing how, the emission profile is bad, but it's just not cool to drive, and it's expensive to make too. You're basically doing two powertrains on a vehicle, and so it's kind of a band-aid approach that I think is a mistake by a lot of OEMs right now.
Ben, as we've been speaking, we got a little bit of news on the leadership of Tesla. This is about Elon Musk. I just want your reaction to it, if we can get it. Tesla said it will call a vote on moving the company's state of incorporation to Texas from Delaware. We've been waiting for that. They're also going to ask shareholders to vote again on the massive compensation package that Elon Musk was awarded back in 2018 and that the Delaware court voided. Ben, can we talk about the leadership and what you'd expect to be the outcome from those kind of votes?
So, when we had a cautious approach when the ruling came out earlier this year, so the end of January, around the package, because Musk kind of said, "I'm going to take my ball and go play somewhere else with the AI." The current investments stay at Tesla, but anything new, if I don't have 25% control, I don't want to do it at Tesla, and I saw that as a risk. I think that going back to that package and going back to the previous compensation package, when it came out, the bearishness around the targets was immense. People never thought they could hit these different targets. The different EBITDA goals, the different goals around the number of vehicles produced, and I think that. Even I was surprised, being very bullish back then on how fast they hit these targets, and I think he should be compensated that way. Now, does Musk do things that alienate people or make people mad? Sure, yes. At the same, I mean, there's no question about it. All the time, people outside of investing will talk to me. Family members, this, that. He's controversial. Same time, he's built several different, groundbreaking, revolutionary, whatever term you want to use, companies out there. And so, I think he's due some credit, a lot of credit, actually.
I think a lot of people might agree with you. Ben, thank you, sir, for the update. Ben Canada of BED, thank you. Thank you very much. We've just had back-to-back conversations, one on Boeing and another on Tesla. And it's almost unbelievable that Tesla is down more this year than Boeing is. Boeing year to date, the third worst performing stock on the S&P 500, down a little more than 34%. Tesla down by close to 37.
In fairness,
kind of amazing.
It is amazing. It also shows you where Tesla's come from and the fact that Boeing's been dogged with a whole bunch of problems for quite a number of years. But this issue of the hope and the prayer and the sort of confidence in the Elon Musk story has been prevalent until now, when it's actually been challenged with real delivery numbers, particularly out of China.
Tesla up this morning by a little more than 1%. Let's get you an update on stories elsewhere. Let's get to your Bloomberg brief with Yahira Hackers. Hey, Yahira.
Hi, John. UK inflation slowing less than expected last month, tempering bets for rate cuts from the Bank of England. Consumer prices rose 3.2% in March compared with a year earlier. While that's a drop from February and the lowest mark since 2021, it was above the 3.1% that the BOE and economists had expected. Traders have significantly pared back their rate cut bets in the UK and are now favoring just 1/4 point reduction this year. Morgan Stanley plans to start cutting about 50 investment banking jobs in the Asia-Pacific region this week. That's according to our Bloomberg reporting. At least 80% of the reductions will be in Hong Kong and China. The job cuts would be the deepest in years for Morgan Stanley in China, its biggest market in the region. And in an interview with Bloomberg, JP Morgan Chase CEO Jamie Dimon makes no secret that his firm is all in on artificial intelligence.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation, it's large language models.
You can see more of Emily Chang's interview with Jamie Dimon on The Circuit tonight at 6 p.m. New York time on Bloomberg Television, or stream it at 8 p.m. Eastern on Bloomberg Originals. That's your Bloomberg Brief. John?
Yahira, thank you. Congratulations to Emily and the team. I've seen the trailer for the new series. Very, very cool. Looking forward to that a little bit later. Up next on the program, higher for longer.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence.
That conversation up next.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
Wow.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
DOJ or other authorities
could face bigger challenges next.
It was going to keep bringing World Cup. This is a 3
as the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Stocks on the S&P 500 firmer here, bouncing back just a little bit from 3 days of losses. We're positive by 0.5%. Yield to lower by 2 basis points, 464 after coming very close to 470 in yesterday's session. Under surveillance this morning, higher for longer.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us.
Here's the latest. Treasury yields touching year-to-date highs and the dollar seeing its best 5-day gain since October 2022. As Fed Chair Jay Powell signals rates could stay higher for longer. David Page of AXA Investment Managers expecting 3 cuts this year, starting in July, followed by 3 more in 2025. David is with us here in New York. David, good morning to you.
Good morning.
You're still a July guy, so let's talk about that. What needs to happen between now and then to make that happen?
Well, I think when we were looking at July and we made the call, we shifted back the call to July on the back of the CPI numbers. We were looking at the fact that the Fed was definitely going to need more time to see a fall in that inflation number come through. And I think, frankly, what we've heard from Powell yesterday is that that time is probably going to be a little bit more. So I think we're probably thinking pushing back now to September, but only to September. But if you're going to see September, again, you still need to see this softness come through. And we're not seeing it across any of the metrics. And I think the biggest surprises have been retail sales and payrolls. Now, both of those are likely to soften, we think, over the next couple of months, and hence we still think that cuts are likely this year. But there is an uncertainty that's unfolding.
I can tell you how this is going to play out this week for you in New York. You're going to meet with clients. They're going to say, you're going to say September, and they're going to scream election in November. What are you talking about? Because we've had so many people push back against the prospect that they'll do anything in September because there is an election a few months later. What's your response going to be?
Well, we hear this every 4 years, right? There's this market mythology that the Fed will never move around an election. And actually, there's that sort of thing about the Fed worrying about the optics. If you look at the stats, You can never, ever see statistically any deviation in Fed policy to economic needs. It always moves roughly around a Taylor rule, regardless of when that election is. So that's not to say the election can't have an effect. Clearly, if markets think such and such is going to happen, financial conditions shift accordingly, they'll have to take that into consideration. But the timing of the election, we don't really think so.
So how do people push back given the fact that most people are not on the same page? I mean, basically, you do have a rate cut baked in by September, but it's shifting as days go on, further out in the year. What would you do differently if you also pushed out your expectation for the first rate cut to December or not until the beginning of next year?
Well, so then you start to see financial conditions shifting. And I think that's the real issue that we've got coming through here, that the Fed is trying to control the economy through interest rate policy, but the economy is probably much more sensitive than we've seen, much more insensitive than we've seen to interest rate policy for a while. And of course, it's financial conditions that are therefore transmitting that. So what you're seeing is financial conditions now shifting quite materially. And I think that's the important thing. The restrictive policy that the Fed wanted in place to try and bring inflation down was really undermined by the easing in financial conditions that we saw from October last year. And now we're starting to see the swing back the other way. So I think that starts to play on the medium-term driver. The short-term driver of rates is going to be inflation. We need to see a softness come through there. The medium-term driver is growth. And with financial conditions now starting to tighten again, and we suspect probably with a little bit further to go, that's going to start weighing on growth. Not so much over the next couple of quarters, but as we move into early next year, and that facilitates further rate cuts beyond.
Don't we have to see further softness in equity markets and even in credit, and we've seen that to some degree over the past couple of trading sessions, in order to get inflation back down to some sort of level that gives the Fed confidence to cut rates? In other words, aren't rates going to remain in this level until you see something crack in markets?
Yes. I think so. And that's the movement in financial conditions that I think we need to see. So, I mean, we have to think that the softness in financial conditions came about with markets incredibly looking for sort of 7 cuts at the height of last December, which always looked unrealistic. Now we're probably going to move a little bit further in the opposite direction. Markets pricing out the prospect of 2 cuts even this year now. And that is having an impact coming through on the rest of the space. But you need to see that come through, to see the softness come through. The easiness of financial conditions probably has helped boost consumer spending over the first half of this year. You probably need to see the swing move back the other way.
There's one issue where you are in complete disagreement with the Federal Reserve, and that's on so-called R-star. Can you just walk us through that as a theme, why you have this big sort of disagreement with where the Fed is at and where you're at?
Yeah, certainly. I mean, the Fed has kept its measure of R-star effectively unchanged since the lows of the GFC. So it sees 2.5, 2.6 now as the long-run Fed funds rate, which is effectively 2% inflation and 0.5% in terms of R-star. To our minds, the R-star level, very hard to define, very hard to pin down. But if you look at what we see in terms of advanced trends in advanced economy growth, they have picked up markedly since the lows of the GFC. We would expect growth trends to be markedly higher over that period. And when we think about the US, there are very clearly some short-term dynamics that see that trend growth a little bit higher still. So we think it's quite natural to see R-star move from the very lows that we saw at the back end of last decade, and we're looking at them being about 75 basis points higher. So we think that R-star is probably around 3.25, high confidence margins around that, obviously. Sure. But higher than that 2.5%. Now, that's not particularly controversial in terms of the market. The market also has that sort of price in place, 5 years up even higher than that still.
Yeah.
So we do think that there's, over the medium term, the Fed is likely to start pushing its R-star views even higher still. But for now, yeah, there is that.
David, enjoyed this, sticking with July, with the idea that maybe they get pushed out to September and the election doesn't really matter. David Page, thank you, sir, of AXA Investment Managers. Conversation will continue the next hour of Bloomberg Surveillance with Sebastian Page of T. Rowe Price, the Ontario Finance Minister, the Admiral, James Stavridis, and Krishna Mamani of Lafayette College. All of that still to come. Equities right now on the S&P 500. If you are just joining us, welcome. Equities are doing okay. We're positive by 0.4%. Live from New York, this is Bloomberg.
You were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
about politics. You've been involved advising presidential candidates, I presume presidents as well. You ever have any interest in serving in a senior position in the federal government or running for office?
Absolutely, unequivocally, no.
The aggravation factor isn't worth it?
It's the aggravation factor, but it's more importantly is I don't believe there's any integrity in it.
So you do give money to politicians, though, because that's the system, but you...
It's part of the game. I think, to be honest, I think there's a need for a multi-party system in the U.S. to give more people a choice about where they can throw their voter support and their political support, but also to cause the country to sort of come together by having everybody have a role in deciding what is in the long-term best interest of the country. I've often believed that Black Americans as a people and as a voting bloc should adopt the same position that the original founders of the Congressional Black Caucus had in early 1970. Their philosophy was enunciated like this: Black Americans should have no permanent friends, no permanent enemies, just permanent interests.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Still a Fed that wants to cut. The key question here is around inflation.
They are in a good place. They can hold rates, but if things deteriorate, they can also cut rates and have a substantial impact.
You could call it a sugar high coming from the easing in financial conditions. That's why supercore inflation is accelerating so quickly at the moment.
We are going to have higher inflation, we believe, for longer, and higher rates.
They need to get away from this excessive data dependence. They need to look forward, and they need to have a view.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The phrase of the morning, and good morning to you all. Pretty fully bully from Bank of America in their Global Fund Manager Survey. The most bullish fund manager survey, they say, since January of 2022. The biggest jump in a global growth optimism since May of 2020. And still bullish. Max Kettner, HSBC, with this a little bit early this morning. Bramo, we extend our stance in high yield credit to max bullish.
Basically saying beyond geopolitics, fundamentals have not changed. We see more tailwinds coming for growth in the coming months. Have not changed. The fundamentals, that is what a lot of people have said. Even if there is some turbulence in the market, they're still going to be investing. That said, at what point do the fundamentals change? If we don't get earnings that overwhelm, and if we do get a yield on the 2-year, on the 10-year, approaching 5% and beyond.
Well, let's go to the prices right now. We can talk about the yield just briefly on a 2-year and a 10-year. We did breach 5% again yesterday for the second time in about a week. At the moment, we're down 2 basis points on a session to 496.20. We've had a massive repricing at the front end of the curve. And this is the point I think that Max is making this morning, Lisa. The starting point is a much more hawkish one now than it was at the start of the year. And any, even only mild, downside surprise in inflation activity data should therefore reduce concerns about the Fed not cutting at all this year. I guess he's saying the balance of risks around this story have shifted quite markedly over the last few months.
At a certain point, you have to hear what he's saying, given the fact that at one point we were pricing in 7 rate cuts. Now we're pricing in fewer than 2. if you really do believe that this is a Federal Reserve that's going to cut rates, this is a market much more appropriately priced at worst, and at best is one that's priced much more hawkishly than what the Fed is actually going to deliver. And this is the thesis that a lot of people have who still believe that the Fed is going to get the ammunition that they have to cut rates before the end of this year.
Before the end of this year, but potentially not before the election. I was looking at, Jonathan, what Powell needs to see before November 5th. There's 4 Fed meetings, May, June, July, September, 7 jobs report, including the one just before the U.S. election, 6 CPI reports, and 7 PCE. You have to think at least half of those have to be almost priced for perfection for him to take that cut.
The director of Renmax still thinks the door is open for July. We just caught up with AXA investment managers. They still think the door is open for July. Let's talk about what President Biden wants to see. We know what he wants to see because today he's going to meet with some 200 steel workers. And guess what he wants to talk about? He's calling for higher tariffs on Chinese steel. Shock horror. We know that as the election campaign starts to pick up, as the year grows older, as we get closer and closer to November, you're going to see more calls like this. This is just the beginning. We're still waiting for a big call on Chinese EVs.
There's going to be a lot of policy levers they can pull before the election to try to tap into certain parts of the electorate. This was the quote that stood out to me when the Financial Times' write-up. It's important for us to get ahead of China's new export surge and their continued pressure on prices that make it hard for American steel companies to compete. Although when you look at what this would actually impact, it's not a ton of Chinese steel. Then the senior official went on to say, quote, nothing to do with elections. If that's the case, then why are you doing it now?
Okay, I don't think anyone reads that on its, say, first surface and says, okay, I guess it's not. You know, I mean, I think everybody understands this through a political lens. Let's be honest. From a market perspective, I do wonder, though, what do you do with this? Do you view this as sort of a sign of what's to come? Do you view this as a policy? Do you trade around it? Do you talk about the next step with respect to electric vehicles? How do you then figure what that's going to do to the complex in the United States? We talked to a number of executives in Detroit. They said it hasn't had a big impact on their auto sales with the Chinese competition yet. So these are the things that make it very difficult. What did Lori Calvasino said? I love this. Staring
at the sun.
Yeah, that's kind of how it feels.
Do you not trust politicians when they tell you it's not about politics? Do you not trust them? It's not about the election.
Look at that bond yield.
Look at those bond yields. Let's get to them right now. Equities at the moment, positive by 0.4%. We can talk about bonds as well. A 10-year getting very, very close to 470 in yesterday's session, then backing away. We're down another 2 basis points to 464.90. Coming up this hour, we'll catch up with Sebastian Page of T. Rowe Price on his aggressively neutral stance. We'll speak to Admiral James Stavridis as the United States weighs fresh sanctions on Iran. And Chris Mamani of Lafayette College on why it's still, for him, a T-bill and chill environment. We begin with our top story. Fed Chair Jay Powell putting rate cuts on the back burner. Sebastian Page of T. Rowe Price writing this. I'm very enthusiastically, with lots of conviction, aggressively neutral between stocks and bonds. What would it take to get us to overweight stocks? Most likely a market sell-off. Seb is with us here in New York. Seb, good morning to you.
Good morning.
I don't want to know why you're not enthusiastically bullish stocks. I want to know why you're not enthusiastically bullish bonds yet, given the repricing we've had in fixed income. Why not?
Well, first of all, as an asset allocator, we spend a lot of time on strategic asset allocation, which you never talk about on surveillance. But part of me being aggressively neutral is saying, believe in your strategic asset mix, all the work that advisors are doing with you. Why are we not more bullish on bonds? I think we will continue to see upward inflation pressure and potentially upward pressure on rates, specifically on the long end. So, Jonathan, we're long in the short end,
got it,
but still worried about the long end.
Do we not have strategic conversations on this program?
Strategic asset allocation.
Okay.
Well, actually, that's not true. We talk about what
the
your defense.
60-40.
Well,
right.
not just the 60-40.
We talk to him every month.
And we do. And also, what about gold
I'm questioning
and
that
bonds?
now.
All right, carry on.
Let's talk about the long end. What are you waiting for? 5%? Are we sitting here waiting for an extra 30 basis points to make this interesting?
Well, I think these moves do matter. And yes, we would change our view at 5%. And look, on the inflation side, just look at Q1 data. We're running at 5% annualized inflation. And this is not what the Fed expected. You know, economists will say, don't look at 1 month of data, don't look at 2 months of data. You know, I'm a runner. I like to look at my watch and see the pace at which I'm going. The pace right now for inflation is 5%. So to me, you know, I look at shipping costs. I look at wages, Atlanta numbers, Atlanta Fed, 4.7%. I look at unemployment, sub 4%. Oil prices, gasoline is up 18%. So I don't think we're out of the, you know, out of the woods here with inflation pressures.
You look like an 8-mile-per-hour kind of pace. Is that correct?
No comment.
All right. Well, just talking about this idea, if you do believe that there is this inflationary pressure and it's going to reassert itself in the United States, why do you believe in a broadening out? Especially because we talk about the divergence between the U.S. and the rest of the world posing a real problem for their growth outlooks and their ability to cut rates materially because of the FX channel.
Yeah, I love that question because there's different ways of looking at the broadening. We're positioned long large cap value, but we're actually neutral now between large and small. Now, think back to 2021. How naive are we to think that bonds can only go down 2%? And think about everything that's happened since then. Imagine I show up with a crystal ball at the beginning of 22, say the end of 21, and I say, okay, we're going to have 550 basis points of hikes. We're going to have the number 2, number 3, number 4 largest bank failures in history. We're going to have wars in Europe and in the Middle East. And what would you think, what would you predict the S&P would do? Probably down. The S&P is up 11% since then. However, on the broadening, the average stock in the world, the MSCI All-Country World Index Equal Weighted, is down 13% since the end of 2021. So that includes more value stocks, emerging markets, small. Where we're making our bet on the broadening is value, which joins the inflation theme as well.
So we're now going to talk about strategic asset allocation here on Surveillance.
That's rare.
I think that it's something we never do, evidently, and I really think we should dig into it. In particular, how you're viewing sort of the idea of a hedge. And we've been talking about this extensively. You don't like bonds. You're worried about inflation. We saw the biggest surge in overweights with respect to commodities in the Bank of America Bully Fully survey. Are you on that same page, that this is a strategic way to sort of hedge inflation in a sort of longer period of time?
Yes, and we like real asset stocks because you get the expected return of stocks, but you're talking about metals and mining and commodities and energy stocks. And strategically, we have a 5% allocation dedicated to real asset stocks in our portfolio. Also, in a regime, in a strategic asset allocation question, in a long-term regime where you get more inflation volatility and maybe inflation stabilizes higher than expected, having a shorter duration position, and maybe, you know, what you can do strategically, take your 40% bonds, shift 10% towards absolute return strategies, right? So that would be a strategic move to hedge against greater inflation volatility. Very popular nowadays, hedging your equity risk, downside protected equity strategies. These are all ways to modernize your 60-40, if you will. So I'm glad you asked about strategic asset allocation.
Where does gold fit in? Where does gold fit into that, if at all?
I think broadly within a diversified real asset equity portfolios. So in our portfolios, our clients don't expect us to trade commodities and have very long specific commodities positions. So broadly diversified in the metals and mining stocks is how we would think about it in terms of.
So then you have an exposure then to the international landscape. I'm thinking United Kingdom, Australia. Is that where you like these assets?
Yeah, and we're close to neutral between international and the U.S. You know, those aren't the most exciting positions, but strategically you do want to be diversified internationally. Now, you don't say that lightly because that's pretty hard to do when the U.S. large cap stocks have dominated for 10, 15 years. So you really need to think about this hard, but it makes sense to have a broadly diversified portfolio.
When was the last time that you really recalibrated the strategy? And what would make you recalibrate it once more, given that right now the market seems to be recalibrating the paradigm that we're in every couple of months?
Yeah, so from a tactical perspective, at the end of October, we bought $3 billion worth of stocks. The market was down 10%. We like to lean in when the market is down. For us, that was a tactical recalibration. We review the strategic asset mix about every year, but I will say now, right now, everybody in the industry, I just spent a week in Asia talking to the world's largest investors. Actually, everybody wants to talk about strategic asset allocation. And now's the time to review what it means to do SAA in a higher rate environment, higher volatility environment. If you go back a very long time history, real rates have averaged 3%. The only exception was the new normal, if you will, the post-financial crisis, which was 0. So I wrote this paper, which is the new normal was abnormal. So the question of strategic asset allocation is on investors' minds right now.
Sebastian, we appreciate having that conversation. I think I prefer the other Page? David Page?
No, I like both of them.
Sebastian Page, a
They
two-row
grew up
prize.
together.
So it's good to see you.
Thank you.
Appreciate it.
Not related.
Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Yahara Heckes. Hey, Yahara.
Hi, John. President Biden is calling for new tariffs on Chinese steel and aluminum products ahead of a visit today to the Steel City. Biden set to visit steel workers in Pittsburgh as he ramps up efforts to shore up the American steel sector before November's election. The president will propose 25% tariffs on certain Chinese products as part of a wider review and will repeat that the company U.S. Steel should remain American-owned. Boeing's safety record will be under scrutiny today on Capitol Hill. The Senate is holding two separate hearings on a whistleblower's claims of poor assembly processes and shortcomings in the 787 Dreamliner program. Senators will hear from a Boeing engineer who worked on that plane for years, plus safety experts from NASA and the academic world. Boeing executives will not be there, but CEO Dave Calhoun is expected to testify at a later date. And Senator Bob Menendez is preparing to blame his wife at his bribery trial. Court documents show Menendez will claim his wife Nadine withheld information from him about gifts the couple allegedly accepted from businessmen and the Egyptian government in exchange for favors. Menendez's legal team is trying to get a judge to try him and his wife separately. That's your Bloomberg Brief. John?
Yahara, thank you. What did you message me last night? Until politics do us part.
Yeah,
Is what you said.
It's basically, you know, nothing says love like incrimination.
Brutal. Absolutely brutal.
It's a charming way of endearing yourself with someone after years of marriage.
Okay.
So they have the gold bars trial, and then I think it's probably headed to divorce trial.
Yeah,
right?
you think? Based on some of that.
Maybe this is what makes them tick, you know? Who knows?
I think we should say less about this if we can. Up next on the program, a Wenger response to Iran.
I fully expect that we will take additional sanctions action against Iran in the coming days.
That conversation up next, live from New York this morning. Good morning.
So you are...
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the...
Stocks on the S&P 500 positive here by 0.4%. Yields a little bit lower, but down 2 basis points, 464.90. Things calmer. And maybe the epicenter of that calm is both the bond market and the FX market too. The dollar weaker, euro stronger, 106.46. Under surveillance this morning, Wenger response to Iran.
I fully expect that we will take additional sanctions action against Iran in the coming days. We don't preview our sanctions tools, but in discussions I've had all options to disrupt terrorist financing of Iran continue to be on the table.
Here's the latest. The US set to impose fresh sanctions on Iran as Israel weighs its own response to the weekend's missile and drone attack. National Security Advisor Jake Sullivan saying the president is coordinating with allies on, quote, comprehensive response, adding we anticipate that our allies and partners will soon be following with their own sanctions. Admiral James Stavridis, the former NATO Supreme Allied Commander and co-author of 2054, a novel, joins us now. Admiral, wonderful to get your expertise on this program once more. It's fantastic to catch up with you, sir. I want to start with this question, and it's what did we learn over the weekend? And by we, I mean Iran. What do you think Iran learned about the missile defense system in Israel?
They learned that it is formidable, that it is comprehensive geographically, and I think above all, Tehran would have been surprised at the extraordinary coalition operation. You know, I've spent a lifetime in the military, a lot of it doing air defense, guided missile destroyer command, for example. The hardest thing in the world is to knit together the Israeli air defense, the American air defenses alongside Jordan, UK, France, and put them all together. I think Iran was unpleasantly surprised at the coalition level, the comprehensiveness, and most obviously, John, at the result, 99% batting rate, knocking down incoming missiles.
Do you think the success of that defense, Admiral, will shape or influence Israel's response?
No, I don't. As follows, the Israelis are clearly looking at it, and I think they should, as a massive attempt to bombard their homeland, something they have not done to Iran. Heretofore, it's been between proxies, fighting more or less. Now you've got the Iranian military, specifically Revolutionary Guards, and elements of the conventional Iranian military launching a massive wave of missiles at Israel. So they will respond. I think they'll respond in a measured way, but clearly they are going to take on this challenge from Iran.
Is there a way Israel could respond to make sure that there's deterrence when it comes to Iran, but not make sure that they're sparking off some revenge cycle in the Gulf?
Yeah, this is exactly the right question. It's the one clearly under discussion in the War Cabinet. And I'd think of it as an ascending ladder of violence, meaning option one, do nothing militarily, but impose sanctions, more diplomatic aggressiveness, try and get all your allies on board, perhaps some cyber response. I think option two is you go after kinetically, perhaps maritime assets, Iranian warships, you up the cyber game a bit. You certainly throughout this are going to go after the proxies. Option three is a strike on the Iranian homeland. That could be fairly tightly packaged, perhaps going after the industrial facility where the drones are built. Option four, and let's hope the Israelis don't pick option four, would be a massive counterattack, hundreds of missiles, both ballistic and cruise, aircraft, all of that thrown at major military targets across Iran. I don't see that latter option. I think you'll find a mix of option two and three as I just described them.
One of those options had to do with the Red Sea, and this morning we have new reporting that there's a naval mission underway with you have the Iranian Navy escorting some of their commercial vessels from the Gulf of Aden to the Suez Canal. Do you think Iran is preparing potentially for some sort of retaliation in these waters?
Clearly they are, and let's recall immediately before, perhaps a day before the strike against Israel over the weekend, the Iranian Navy, in what can only be described as an act of piracy, seized a large merchant ship that is ultimately owned by Israel, by an Israeli business concern. So Iran kicked off that cycle as well. I think the Israelis have to be contemplating something in retaliation for that, hence the escort by the Iranian warship.
Admiral, I've been trying to understand why Iran has felt so emboldened to take these new steps to directly attack Israel on its own land, to move out of the shadows. How much is Iran being emboldened by its relationships with Russia and with China?
Oh, you've put your finger on it. That's what's different. Over the last 3-4 years, particularly Russia, Iran is beginning to feel very comfortable in this partnership they have developed, which at its heart is transactions for weapons, with Iran providing very significant, fairly sophisticated drones to the Russians in their attack on Ukraine. This, in turn, feeds the Iranian sense of having, if you will, a larger coalition partner behind them. And then finally, with China, Iran is fully engaged in the Belt and Road Initiative, has received billions from the Chinese in investments, more of an economic relationship there, but both of those have emboldened Iran.
Admiral, given the fact that they have their own coalition or the appearance of one, how much do sanctions really work, to the extent that they've worked at all to this point?
I think sanctions are always an imperfect tool, and we can go back to the global sanctions imposed on South Africa during the apartheid era. It took decades for them to really create a sense of economic disadvantage, which caused a part of why South Africa changed course. So this is, anytime you impose sanctions, it's going to be take time. And here, you're absolutely correct. These are pretty leaky sanctions with at least 1/3 of the world's GDP, maybe a bit more, simply not participating. Not only China and Russia here, but for example, India not participating in the sanctions against Russia that were correctly imposed in the Ukraine war. So it will take time. It's better than nothing. But we should not believe that it will be the path to changing the course of Iranian bad behavior.
Admiral, you mentioned China. Can we finish on China? You're out with another book, the follow-up to 2034, again with the brilliant Elliot Ackerman, a good friend of this program as well, like you, Admiral. The 2034 book was a novel of the next world war. And I just want to talk about the situation between China and the United States. I don't know about you, Admiral, but waking up this morning and hearing the president talk about the prospect of upping tariffs on Chinese steel and referring directly to building ships in America, what do you think we're drifting towards here?
I think, unfortunately, we are drifting toward the possibility of more tension in the relationship. But I'll close my reappearance on surveillance on a mildly optimistic note. I think a good deal of what you're going to hear in that regard over the next coming months is, in fact, tied to the election cycle in the United States. Once we get through that, I think that there will be a possibility of the two sides finding their way to a better modus vivendi. There are clearly going to be no-go zones in the relationship over everything from Taiwan to South China Sea to military competition itself. But I think the possibility of continuing to have coupled economies and not stagger into a decoupling of these two massive economies, I think I'm cautiously optimistic we can work through that after the election.
I think we can all agree we hope your great novels remain just that, novels, fictions. Admiral, thank you, sir. Admiral James Stavridis there, former NATO Supreme Allied Commander. Bramo, certainly a big focal point going into November.
Especially because this has got legs on either side of the aisle, right? This is not something that's just going to live and die within just this election cycle. And it raises to the question, are we realizing we're in a new world where China wants to do one thing and we have to fight in a different way?
Trump or Biden, Chinese tariffs are on the way. Doesn't matter.
Big time, big time. Coming up on this program, Canada raising its capital gains tax in a bid to make housing more affordable. That conversation up next. We'll catch up the Ontario Finance Minister. That's just around the corner.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down the path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to like build a path towards that. It's almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
When I was younger, I used to be in bands. I'd play drums in bands and toured America with them. Did a lot of session drumming, recorded albums. So yeah, it was good fun doing the drumming. The only reason I stopped it, well, I still play, but not as serious as I did when I was younger. But drumming doesn't pay the bills. I was never good enough to be able to pay the bills with it, but it was good fun. I started RJF, and the reason I started it was I saw a gap in the market for particular early stage and startup businesses. With the experience that I've got of running businesses, of being a finance director at the very biggest companies in the world to being finance director of small startups, we were looking at providing more than just basic accountancy services. So yes, we'll do all that, we'll do all the basic, all the statutory side of things that you need to do. But there's so much more value that we can add, and I wanted to have my experience to help these startups, because a lot of them don't really know where to go. You can go to your high street accountants and they can do a good job compliance-wise, but you would question whether they've actually been in the firing line of a business. Have you been in a business where you're thinking, how do I pay wages next week? Or business is really successful, what do we do with it next? Or how do we grow it? How do we grow into international territories? Or how do we grow our markets? How do we expand? So a lot of the experience I've seen over the years and seen different types of business in different sectors, I thought, well, it's a real value that I can add to these businesses as opposed to just being an FD, because a lot of these businesses can't afford an FD. But if we can take care of their statutory side of things, the compliance side of things, I'm on hand to be able to help and advise businesses with their growth strategy, or if they're in difficulty, help them through these times.
Auction today, see if there's still the demand for U.S. bonds. Yeah.
It's an odd one, though, isn't it?
It's such a weird
20-year maturity.
Yeah, but
is it still that kink on the yield curve?
Yeah,
where the 20-year is?
Yeah, because basically it's less liquid, so you have higher yields on 20-year than 30-year. That's the kink.
Why should I care about that?
Because,
why should I care?
You're right. You're absolutely right. And then it's going to come in a weak auction and everyone's going to freak out and it's going to direct the rest of the move and the rest of the afternoon, because this is the concern. It's just fueling that narrative of supply versus demand and the imbalance.
Well, the mood of the moment is okay. And maybe thanks to what's happening in foreign exchange, or rather what is not happening. We've had a lot of dollar strength recently. We've hit the highs of the year and we've backed away. The euro's a bit stronger on the session, the yen as well, sterling too, cable at 124.58. But I think this is still a problem. 154 on dollar yen, Lisa. And you mentioned China as well, for the Chinese currency. What do you do with this? The dollar just absolutely ripping over the last few months.
You could argue that maybe they want a weaker currency, but to what extent? On the other hand, how much does this tie the hands of the People's Bank of China to cut cut rates at a time where they want to juice growth much more than they're seeing currently.
The dollar's in the driving seat. Let's get to the top stories. Under surveillance this morning, Fed Chair Jay Powell pumping the brakes on rate cuts. Powell saying recent data indicates it will, quote, take longer than expected to achieve confidence that inflation is headed back to target. Anne-Marie, the emphasis of the last 24 hours, in fact, the last month or so, the emphasis is on time, the time it will take to get back to target.
Can't hurry rates because he doesn't see the confidence. The confidence isn't there in the data. And then you look at all the data that's coming out, because the reason why everyone cares so much about this year and the time is because there's a huge election in November. So they have 4 Fed meetings before that election, 7 jobs reports, 6 CPIs, and 7 PCEs. It's not a lot of time for them to see. It can't be just one print. It needs to be at least 3. And he pretty much tactically said yesterday and implied, yeah, it's not bumps, as we've all been talking about. This looks like a trend.
It's kind of funny to me that it's either July or December for so many people, with the exception of maybe David Page of AXA, who was with us this morning, who said September, and he thinks it can happen in September because he doesn't think the election matters that much. But for everyone else, if it doesn't happen in July, they believe the window's closed and you have to wait until after the election, and you can't go immediately after it. You've got to wait until December. Do you buy that? Does it matter that much?
It depends whether the data is sufficient to really justify it in the market's eyes. If you get sufficiently weak data, my God, I sound like someone who's speaking from the Fed hymnal, but if you get sufficiently weak data, you will end up having the justification to cut rates. If it's on the margins, on the edge, wait till December.
Do you speak like a Fed official at home?
I do.
Around the dinner
I
table?
say, this is sufficiently inappropriate behavior to please leave the table.
I bet the family loves
They
that.
love me.
Let's get to this story. I'm sure they do. United in the pre-market, positive by something like 5%. The airline reporting better than expected results this quarter, and second quarter forecasts that beat estimates, easing concerns that aircraft delays from Boeing and regulatory pressure could put its expansion plans at risk. That stock is up right now, Anne-Marie, by 4.99%.
They're walking this line very carefully, and people were pretty surprised on how well they did, given the issues with Boeing. But I look at this and I say, ooh, they're not expanding as quickly as they want. Yeah, they're making some moves to their domestic capacity. But what does this mean for airline prices this summer? Because it feels like they're going to be going up, especially on top of that, not just Boeing on one end, but jet fuel prices are going up with oil and gas prices higher.
What would you prefer? Free internet, better snacks, but kind of, you know, an old plane to
I'd
fly
take a
in?
safe flight.
Well, no, I mean,
I'd
it's safe
prefer
but old.
a plane without the ashtrays in it.
Okay.
You know, one of those.
We're not flying
Stop
Connie.
flying Air Italia.
Okay. You know, the planes from 30 years ago.
Okay, I'm just saying, because they're going to probably be older planes, but then we just heard from Sheila that they're going to just offer some more amenities. I don't mind.
Well, they're going to give you better food and free Wi-Fi.
Yeah.
So long as you fly the plane with the ashtray in from 30 years
We're
ago.
not flying Connie. You should go to the TWA
All right.
museum.
You
It's
let me
really
know
cool.
who you fly with today.
Okay.
And let me know if it's got ashtrays in the front. All right?
Carry
Let's turn to the news out of Canada. Raising its capital gains tax on businesses and wealthy individuals as part of a bid to make housing more affordable. The announcement coming amid poll data showing Prime Minister Justin Trudeau losing support among young voters over housing prices, which have jumped around 60% in Canada since he took office. Joining us now, I'm very pleased to say, Ontario Finance Minister Peter Bethlen-Fulvey. Minister, fantastic to catch up with you, sir. Thanks for being with us.
It's a pleasure to be back in New York.
What did you make of that tax change, that announcement, just yesterday evening?
Well, as a conservative provincial government, I never believe that taxing your way to prosperity is the way to go. So, and they did nothing on the carbon tax. We have a carbon federal tax in the province of Ontario. We cut the gas tax, so we're going one way, they're going the other. But I just don't think you can tax your way to prosperity.
Is this going to hold back investment, do you think?
I don't think so. Ontario's 40% of the Canadian economy, and we're booming. We've got, over the last 2 years, 1 million person population growth, growing faster than Florida or Texas. People are coming to Ontario, so we're rebuilding the economy. We've got capital flowing in. We've had $28 billion of capital investment in the electric vehicle production, supply chain, and assembly. We've got growth in many parts of the economy, advanced manufacturing, and we're building, everything like highways, subways. We've got more subways, more cranes going on in Ontario. So it's a real opportunity to build the economy.
How much does particularly the capital gains tax hike lead to actually more unaffordable homes, just because people aren't going to be selling them if they're going to be taxed to such a high degree?
Well, this is, to be clear, this is not on your primary residence. So in Canada, your primary residence is exempt from capital gains. So it's not really going to affect the residential home market. Look, we've got a robust plan, and I will give the federal government some credit that they're investing in the infrastructure to build more homes. So water and sewage not the most exciting thing, but it's the plumbing that you need to build more homes. We've got an ambitious target in Ontario to build 1.5 million homes, and we're going to do everything to get there.
How do you get the confidence from investors to actually have the capital to do that at a time where growth is weakening? There's a real question about the sort of debt overhang. We're dealing with that in the United States. And the whole idea of how you're going to raise that revenue could curtail growth, which makes it even less attractive. How difficult is it?
Well, again, we're in Ontario, which I'm the Minister of Finance, we're 40% of the country. So as Ontario goes, Canada goes. And as I mentioned, we've got the population growth. We just issued a 10-year U.S. bond yesterday. It was very well received, and we had more investors for a U.S. 10-year deal out of Europe, Asia, and the Middle East than we had in the U.S. So we're getting broad demand. And so I think that we're just going to continue building the infrastructure, rebuilding that economy. And the other thing that we're doing with that population growth, we put a lot of money into reskilling and retraining the workers, and particularly in the skilled trades, because you need people who actually know how to build the hospitals, the highways, the subways.
You want that population growth. That's what's interesting, Keir. When I talk to you, when I hear you speak, you are fiscally somewhat conservative. But when it comes to immigration, you have a very different view than maybe some Republicans might have in this country. Your population in your province has gone up to 16 million. This is by design. It's what you want to see as well. What is that turning out to be like? How is that working out? Are you able to build housing quickly enough to accommodate the people that are coming into your area?
It's a good question, and yeah, it's not. We can't have immigration and not have the infrastructure in place: the schools, the hospitals, the highways, the subways, the transit to move people. So it's a balance. I'm the son of Hungarian refugees from World War II, and other than Indigenous, everyone in Canada came from somewhere else. So it's been the Ontario dream, the Canadian dream. We've been a beacon of stability and hope for many people around the world. So we welcome that. But we have an obligation in Canada to make sure that we can accommodate that growth. And I think that's what you're talking about. And we've got a plan in Ontario to do that.
A lot of analysts I talk to say the United States trains high-skilled workers and Canada steals them. Is that actually what you see going on?
We're pretty shameless in Canada. So we accept people from all over the world. And my wife is American, born here in New York. That's the tradition and history of Canada, that we're welcoming of people around the world. And they just want to, when they come to Canada, they want to have a good job, they want to feel safe, they want to be able to raise a family. So that's why our government is very focused on making sure that we combat crime, we have the infrastructure, we rebuild the economy, and we train the workers for the jobs of tomorrow.
This feels like a big investment phase for you, and not just you, but also at the federal government level as well. How do you balance the budget with that in mind?
Yeah. So in Ontario, I'm the only major jurisdiction in Canada to have a path to balance. We balance at the end of in about 3 years. So we have a path to balance. Yesterday, the federal government, they did not have a path to balance over the 5-year period. We're committed as Conservatives in Ontario to we think we can do both. We think you can have a healthy economy and a healthy balance sheet. You can do both. And that means that we're not passing on a lower standard of living to the next generation, or that they have to raise taxes or cut spending.
How do you then adjust expectations when it comes to benefits that people receive from the government? This is a question that the United States is facing in a significant way, given the deficit here. Do you have to cut back in certain areas in order to provide that stability for future generations?
No, we don't. We do index some of the support payments, like our Ontario Disability Support Program, low-income seniors, we index it to inflation. But we've chosen a different path to be able to afford all those payments and all the infrastructure that we're building by growing the economy. So we just believe in economic prosperity and putting in place the conditions to be able to let people and families and businesses grow.
Yesterday, we had Jay Powell sitting next to the Bank of Canada governor, and they're talking about the export back and forth and the friendly relations between these two countries. But this administration, with the Inflation Reduction Act, many in Canada lobbied before it came out, saying this was protectionist to the United States. How is this? Where do you see this going now? Have they assuaged the concerns that the Canadian government had before this came out?
Yeah, there were some concerns for sure. A buy-only American. And we said, hey, look, we've been a trading partner for a couple of 100 years and on good terms. We're your friend. We're your ally. Work with us. So we found some common ground. And to their credit, the administration excluded Canada from that provision. The Inflation Reduction Act, we responded. We'd prefer not to see protectionist type measures. We're a free trading country. We championed free trade in 1988 with Prime Minister Mulroney, who sadly recently passed away. But we continue to believe in free trade, and the United States is our best friend and ally on the planet. So we'll continue to find ways, as we have for the last couple of hundred years, to do deals.
It's ideal to find someone else that believes in free trade. Can you find them right now? Do they exist? Who are they?
Well, we're a small, open economy, so we do continue to trade. We have a trade deal with Europe. We have a trade deal, obviously, with the U.S. We do a lot with Asia. As I just mentioned, our bond issuance was...
Oh, without a doubt. The reason I asked the question, Minister, as you know, it's all well and good you believing in free trade. I do as well. But the problem is there are leeches on the free trade system, and one of them has been China, which is why we're in this position anyway. And what we're seeing now is the rise of industrial policy in America because of what's happened in China, because China's been very successful developing industry doing just that. We're going to see it in Europe too. How does Canada compete in a world where everyone seems to be drifting towards really big subsidies and manufacturing that is local and not international?
That's a very fair point. You know, we just continue to find ways, like in advanced manufacturing, life sciences, technologies, to set the conditions within. Government doesn't create those jobs. The private sector does. So our view is, you know, as Prime Minister Harold Macmillan said many years ago, the toughest thing in government is events, dear boy, events. So we deal with events, and we're very nimble in Canada. We're a trading country, and so we know that we'll be able to come out the other side through the economic cycles.
Minister, we appreciate your time. Thank you, sir. Enjoy New York.
Thank you.
It's good to see you.
Be with you.
Peter Bethan-Fulvey there, the Ontario Finance Minister. Let's give an update on stories elsewhere. We can do that with your Bloomberg Brief. Let's cross over to Yahara Hakez. Hey, Yahara.
Hi, John. The SEC is cracking down on the use of third-party messaging apps on employee phones. The agency is now restricting access to platforms like WhatsApp, plus SMS and iMessage. The restrictions are meant to help improve record-keeping and address potential security vulnerabilities. The SEC's Twitter account was hacked earlier this year through a staffer's agency-issued phone, which resulted in a fake post announcing the approval of spot Bitcoin ETFs. Tesla will ask shareholders to vote again on its compensation package for Elon Musk. This after a court in Delaware voided the $56 billion payout arranged for the company's CEO back in 2018. In a proxy filing, Tesla also said it will call for a shareholder vote on moving the company's state of incorporation from Delaware to Texas. And record rainfall in Dubai led to flights being diverted and cars being left stranded on flooded roads. It's the heaviest downpour in the United Arab Emirates since 1949. That's according to Dubai's media office. It comes after the UAE has been carrying out cloud seeding, an operation involving spraying chemicals into the atmosphere to squeeze out more rain from clouds. It's done that 7 times this year as it aims to address water security issues. I learned something new. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. They got the rain they engineered, right? This is what they wanted, and they didn't develop the drainage. This is like, you know, infrastructure. First.
Right. Well, they've been doing it since, what, 2002? I mean, they've been doing it for a very long time, and this has been a complaint. I don't think that anyone was expecting a deluge.
It's just always what the government does, though, right? You know, they're doing it with EVs right now. Buy EVs, and then we'll do the charging stations.
I feel a bit...
Infrastructure first.
I feel a bit like Glass House, because, you know, in this country we have...
I'm not sure, without a doubt. There are plenty of issues.
I mean, really, look around the world. Who does it the best?
Home country, too. Problems all over the place.
They do it really well.
The Swiss probably do it the best,
their infrastructure just
Up next on the programme, putting rate cuts on ice.
If inflation gets much worse, they could hike. I think the likelihood of them hiking is low. Is it zero? No, they could.
What was I thinking? Canada, of course.
Go to Canada.
Forgive me. From New York City, this is Bloomberg.
The top names in tech are on Bloomberg.
There's a natural tension between the need of a supplier to scale and the need of the customer, the car maker, to differentiate, try to make something that is unique.
We have a long-term partnership with Tesla, and it's still strong, but Tesla is not the only partner that we're seeking, and we want to diversify and really make the EV market in general stronger and sustainable.
All these devices becoming smart devices, they all need a brain inside that helps them learn what to do. That brain inside is ARM.
I'm believing the next user experience is going to
to be based on Gen AI on their phones. We're optimistic that we could start to see devices as early this year.
Our job is to provide great index products and then to be the listing exchange for those index products that allow investors to invest in all sorts of tradable instruments, including now Bitcoin.
Nobody covers technology like Bloomberg. Context changes everything.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Great World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Equities on the S&P positive here by 1/3% on the S&P 500. Bond yields settling down. We're down a single basis point, 465.52. Under surveillance this morning, putting rate cuts on ice.
If inflation gets much worse, they could hike. But I think if they do hike, we're going to have a regional banking crisis. We're going to have all sorts of damage in the marketplace. And I think that is at the back of their head. So I think the likelihood of them hiking is low. Is it zero? No, they could.
Here's the latest. Yields hitting year-to-date highs, with the 2-year briefly touching 5%, as Fed Chair Jay Powell signals a delay in rate cuts. Krishna Mamani of Lafayette College writing, quote, "We remain in a range-bound market at best, with it getting buffeted by geopolitics, the Fed and data. While the economy is doing well, it is probably still a T-bill and chill environment." Krishna is with us around the table. Krishna, good morning.
Good morning.
I am surprised, sir, that we haven't had people come on this program banging this table saying buy bonds. Why not?
Well, so buying bonds and buying T-bills is two separate things. So I think the rally that we had in bonds beginning November had to be unwound if the economic data was going to be as strong as it is. And that is what is taking place. I think 10 years today are much better value than they were before, but they can still steepen a little bit more. But T-bills, on the other hand, provide you a really good, or 2-year for that matter, provides you really good return in an environment where things are not moving in one direction in a big way, either in bonds or stocks.
Well, let's go to the opportunity and the balance of risks around the 10-year right now. The 10-year sitting, let's call it 470, so 465. What's the risk? We go another 50 basis points higher or 100 basis points lower from here?
Yeah, I think probably 5% is probably the upper end, and that basically requires the Fed not to do anything for an extended period. But if we have a significant slowdown, we are going down 100 basis points and in a hurry. And that probably creates all sorts of situations that increases demands for long duration in a big way. I think that's the kind of the convexity of bonds at the moment.
I understand the T-bill side.
Yep.
I don't understand the chill side, in part because at a certain point...
Because you have no chill?
Well, no, I have no chill.
I think that's a you problem, Lisa.
One second. There's a question, though, about going forward. If you really believe T-bills are the best bet, that implies weakness down the line. That implies something that is less than chill.
Well, no, not really. Well, what that is saying is that the upside in stocks is very limited in the current environment. So you need two things to work out. One, earnings to continue to grow, and for rates to kind of either stabilize or come down. One leg is, I think, working. It remains to be seen how long it'll work. So the point is, given where the market is relative to earnings outlook, the upside is very modest and the downside is significant if we have a 100 basis point cut in rates in a hurry, because we are now talking about a recession as opposed to a soft landing that we had been talking about for a long time. So it's a kind of a placeholder more than anything else. At 5%, that's or 5 and change, it's a pretty good placeholder.
So you're still in placeholder mode. That's what I find interesting.
Yes.
What are you waiting for? to get some conviction?
Well, so I think what we are waiting for is really confirmation that the economy can continue to grow, and in an environment where the inflation continues to trend down. What we haven't seen in this year so far is inflation continuing to trend down. I think that's what we are waiting for, that data to come about, because the longer the Fed holds at 5 and change for, let's say, till the end of the year, the risk in the equity market is actually increasing rather than going down. So that's what we have to be mindful of in the current environment.
Given Jay Powell's comments yesterday, do you think they hold to the end of the year?
Well, I think a month and a half ago, he was talking about cutting in June. So I think they are as data dependent as the rest of the market is. And if things slow down, they probably bring it forward rather than later. But the challenge for the economy and the markets is there's really no significant sign of any slowdown in the economy. And until that comes about, everything is speculation, whether it's Jay Powell or us.
The emphasis seems to be on time, wait, and keep rates at current levels. They keep saying this, at current levels. Do you think we are sufficiently restrictive? Or are they just waiting for inflation to come down a little bit more and then real rates sort of narrow the gap and then they are restrictive and where they want to be?
Well, I think, for you to truly claim whether we are restrictive or not, you have to have a handle on where our star is, and none of us do. So let's admit that up front. Having said that, I think the true sign of tightness is, did the market rally when they were going to cut rates, and did the market sell off when they said they are not going to cut rates? And that sort of tells you as to how we are interpreting the current situation.
If someone were to come to you and say, I get T-bill and chill, but what about T-bill, chill, and gold?
Well, I have always had a tough time with gold for non-yielding assets. So, it's very hard. It's like Bitcoin for me. It's very hard to wrap my head around something like that. When you earn 5%, that's 5% of appreciation that you have to deliver from a competing product.
At least they're struggling to keep it together. So let's build on the gold story a little bit more. What do you think is driving things at the moment? What is behind that breakup? It's really, really odd to see gold rip, the dollar stronger, and yields climb. What is going on there?
Well, so, the dollar stronger part is easy. The rates are going to remain a lot higher. So that part of the check. The gold part is we can make any story we want. That's what the problem is. So China is buying. People in China are buying. It's kind of replacement for yuan in some way. Or people in India all of a sudden started buying jewelry. I have no idea. The point is, it's a speculative rally, and it'll probably continue as long as the market uncertainty continues. If the direction of rates becomes a lot clearer, I'm not so sure gold would be doing as well as it is right now.
There's plenty of arguments for why gold is up here. Totally with you. We all agree. There are some people, though, there is one argument that is suggesting that it's very difficult to understand where I can go to find risk mitigation characteristics if we have some problems, and that problem might be higher inflation. Lisa's been asking about whether treasuries fulfill that role anymore. Does gold fulfill that role?
Well, I think if you think the gold fulfills that role, you have to believe that other places like China, which hadn't been buying gold in a big way over the, let's say, last 20, 30 years, all of a sudden are going to stockpile that. And that may indeed be the case. I don't know. I don't have that information. But it has to be some additional buying. The non-yielding characteristics of gold hasn't really changed. That is perennial. So in that sort of a context, you basically have to believe one of these stories with very sparse data, and I just can't get myself there.
You and I have talked for a long, long time, and I often ask you, biggest risk, upside risk or downside risk? And for a while in equities, you'd been saying upside risk. What about now?
Well, so the reason for T-bill and chill is the market environment is extraordinarily uncertain. And I think the upside in equities from current valuation levels is modest at best. And for that, a whole lot of things have to fall in place. So I think the upside is relatively modest, but doesn't mean the economy is not doing well and we are going to have a 20% correction. So from an optionality standpoint, it's worth owning. Having said that, having a full allocation or a significantly higher allocations in equities because of the perceived upside, I think is a tough case to make right now.
Krishna, you're brilliant, and this was awesome. Thank you, sir. T-bills and chill. Krishna Mamani of Lafayette College. Not much chill around this table.
Well, look,
just a little bit of chill.
First of all, I think it's a fascinating idea. I actually think it's really smart because it's basically, everyone comes on and says that they have no conviction. So where do you wait? And the idea of waiting and truly deciding to wait in an asset class that delivers some returns. It's an interesting concept.
Good. Coming up on the program, Alicia Levine of BNY Mellon. We'll catch up with Akash Doshi of Citi, Diana Peterson of the Conference Board, and Bloomberg's Mario Parker. The third hour of Bloomberg Surveillance up next.
The shape of the On athletic shoe is unique. It can't be mistaken for any other brand. The structure of On's C-suite is just as distinctive, starting at the top with a pair of CEOs.
What we realized very early on is if you're adding different capabilities to each other and you do that as equals, then this leads to better outcomes.
Mark Maurer joined On as Chief Operating Officer in March 2013. Martin Hoffmann arrived as CFO that July. In 2021, they jointly assumed the CEO role.
We are a brand that needs to be excellent in designing product, in innovating product, but also in shipping millions of parcels from A to B in the most efficient way. So we need to have very different mindsets and very diverse people. Mark has different strengths, I have different strengths, and if you take us together, you just get more.
Companies with co-CEOs are rare, but On's configuration is even more unusual. Martin Hoffmann also holds the CFO position. He says his two jobs complement each other.
I actually feel the CFO makes you a better CEO, and the CEO makes you a better CFO. Understanding what you build as a CEO helps you to understand your numbers, and understanding the numbers helps you what are the right things to build.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big, with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
This is Bloomberg.
The U.S. is leading, and this is one reason we remain overweight U.S. stocks.
The U.S. dominates in relative space. It dominates almost regardless of what the global scenario is.
I think that we are in the midst of a game changer on technology.
The bar for earnings to surprise to the upside has risen.
For now, the economy is certainly riding the wave of the increase in the stock market.
This is Bloomberg Surveillance with Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance begins right now. Your equity market on the S&P 500 positive by a third of 1%, looking to bounce just a little bit here on the S&P 500. For me, always fascinated with the psychology of markets, particularly in fixed income. Let's get up the fixed income board and talk about this. What is it about bonds? You get a 50 basis point move higher, no one wants them. You get a 50 basis point move lower, everyone can't get enough. Bramo, momentum trading in fixed income.
And it's been, frankly, the momentum trade everywhere, but fixed income in particular, it seems as though this market is as whipsawy as some of the Fed speak has been, that basically you have data dependency in markets, you've got data dependencies at the Fed, and so basically every data point is cause for another 20 basis point move in bonds. And that's essentially what you're seeing, and it's hard to get ahead of that and move the other direction because we've seen this overshoot time and time again.
We've had tons of Fed speak over the last 24 hours, including the chairman of the Federal Reserve, but we also heard from the vice chair too, and I keep going back to this quote from the vice chair because I think it's the most important quote we've heard in the last 24 hours. If you thought there was a threat of higher interest rates, take a listen to this line. My baseline outlook continues to be that inflation will decline further with the policy rate held steady at its current level. They're just going to wait, Lisa, and wait a little bit longer and wait a little bit more.
You know, Powell even basically indicated that they're not going to hike rates also. He said, on the other hand, this inflation isn't a standard case of overheated demand. This is an issue with something else. This doesn't indicate that they need to kill it off like some sort of inflationary beast of the 1970s. And this is the reason why people are saying the upside risk to inflation is not necessarily in the same way baked into the markets, or should it be?
And Powell's saying recent data has not given us greater confidence, so they need more data, which I think without saying it, Lisa, you've brought this up, these are no longer bumps. This is now becoming a trend, and that timeline issue is going to be incredibly important.
The emphasis has changed, and we've talked about this a million times on this program. In August of 2022, where Chairman Powell was at Jackson Hole and he delivered that 8-minute speech about pain, the emphasis was on pain. Now the emphasis, a few years later, is on time. Now, what you've got to work out as an investor, are yields up here, are they not cutting for the right reasons? Because growth is good, and that's coming with some kind of inflationary impulse. Is growth good enough? Will earnings be supportive of some of the valuations that we've got to over the last few months?
It's an uncomfortable time. And honestly, the sort of delinquency data that we keep seeing on credit cards and auto loans give pause. The idea that you are seeing small businesses struggle with higher benchmark rates. There are some reasons you could see this economy slowing more materially, which is the reason why there's a little pain. It just isn't widespread enough to get into the average numbers. And that's the reason why some people think maybe this is a real weakness.
Which is why after Powell spoke, I looked up Senator Elizabeth Warren's website, her tweets, have yet to see anything yet. But you can imagine if he's talking about this is going to be a lot longer, and everyone's talking about potentially now it has to be after November, there's going to be a consensus in Washington on the Democratic side of the party that's going to say, well, we've been asking you since January to bring rates down. It's hurting some people in the electorate.
Yeah, I'm not sure that's how it works, just because the Democrats asked, the Federal Reserve has to deliver. But I imagine we might get a few more letters going into November.
Yeah, which is the reason why they're not going to cut rates in September. This is at least according to a lot of people in the market.
And that's the problem for many people. September, why it can't be September? Why can't it be September? I don't get it. If the data's there, just cut in September.
And also, arguably, Powell did the best thing he could do for Biden when he just said there was going to be a pivot. And then we've seen this bull market rally. That is when he helped anything help the electorate in terms of how they view the economy and Biden. I don't think, given the lag effects of monetary policy, September is going to matter to November.
The reason why I was laughing so hard at T-bill and chill is because telling Wall Street to chill is ridiculous. There are all these really intelligent people who are paid to analyze and get ahead of the markets, and there's no way to get an edge on this. So there are people coming up with every narrative under the sun when really they have to be chilling and watching the data. It's a very difficult nut to crack. I understand that personally, but this is basically what we keep seeing.
You're super chill. Equity futures right now on the S&P, positive by 0.25% in the bond market anytime. Yields are lower by a single basis point, 465.52 on a 10-year. The dollar's weaker today against the bulk of G10, the euro firmer, 106.40. Coming up this hour, BNY's Alicia Levine on why markets can still reach new highs. Cities, Akash Doshi looking for gold to hit 3K, and Dana Peterson of the Conference Board on C-suite optimism. We begin with our top story. Fed Chair Jay Powell signals another delay in cuts. BNY's Alicia Levine saying this: the market is more aligned with the Fed than 3 months ago. That move from 6 to 3 hikes happened with barely a hiccup in the equity market. We think the Fed will cut less and later. It could be 2. As long as the economy is strong and the labor market is resilient, the equity market can handle less and later. Alicia joins us now for more. Alicia, good to see you.
Good morning.
It's been too long. Let's talk about how you framed the year. We're talking about a year of two halves. I think the second half was going to be a little bit better, maybe, than the first half. How's that shaping up now?
So it looks like the first half was very, very strong, obviously coming into the first quarter up 10% on the S&P, up 11%, including dividends. Look, we're clearly walking into a counter story here in the last few weeks. So it's not just that the rate cuts are less and later, but it's also, is inflation higher? And then Powell yesterday just sort of said the part that we were all thinking, which is, are there no cuts at all this year? But to your conversation earlier, I think the issue is the pivot already happened. The pivot happened in December. To pivot from the pivot is going to be a very difficult thing for the institution. So we're in a place where, you know, the Fed can hold this high for longer, but I don't think we go higher, right? So we're not pivoting from the pivot. And ultimately, the data really are hanging in there. I mean, the job market data has actually been extraordinary. And if you just look at a rolling 3-month average, you know, 6 months ago, that rolling 3-month average of job creation was 220,000 jobs per month. We're now at 275,000 jobs per month. So we've ticked right back up in what is supposed to be a slowdown this year. And we've done it with wages quietly ticking lower. So there's a supply story going on in the labor market that I think the Fed is hanging their hat on here to kind of quietly bring inflation down on the labor side, on the wage side, even as we see some higher numbers in the services.
I remember you called 2021 the COVID excess years, 22, 23 were the transition years, and you were setting up 2024 to be the new normal?
The new normal.
The new normal. Do you think we're still in the transition years, or is this really the new normal?
So this feels like the new normal, which is we seem to have better labor supply. We have an economy that can grow at 2.5%. And we have inflation that's probably not going down to 2% anytime soon because we have some deglobalization, we have reshoring, and of course, we've got hot conflicts in two parts of the world where commodities matter, food and energy. So we're in a place of, let's call it 2.5% to 3% inflation as a steady state. That feels about right. We're also in a place where growth is likely to be higher than that 2%, which we had in the post-global financial crisis world. So I think this is the new normal. This seemed like it would be the new normal. We've had hiccups along the way, but this doesn't feel problematic, right? We've lived in this world of 2.5% growth and 2.5% to 3% inflation quite well with 5% yields.
It's not problematic for Google. It's not problematic for Microsoft. It's really problematic for a lot of smaller companies that are struggling with highly leveraged balance sheets. At what point does that become a problem for the broader market, given that that's sort of the steady drum that hasn't gone away in the backdrop?
Right, so that's true. There has been a bifurcation here, and it's like the slow wringing out of excesses and leverage in all these challenged balance sheets. So you see it in the Russell, for instance. That Russell's down 3% this year. There was a lot of hope last year with the pivot that this asset class would finally rally, still 25% below the highs of 2021. It is happening across the economy to smaller businesses, but the larger cap companies and the larger companies in the U.S. termed out their debt, meaning just like households, which termed out their debt at 3% mortgages, fixed rates. Large companies, you know, sold bonds in 2020 and 2021 at 3% and 4% interest rates, and those are not due. The bulk of the S&P, that debt is not due until 2030 or later. So you have stronger companies, larger companies actually paying out debt at 3% and 4% and getting 5.5% on their cash, similar to what households are doing as well, just keeping that part of the market really solid. So the structure of the U.S. markets are going to protect the S&P from what we're seeing in some of those smaller companies. And yes, if the Fed keeps high for longer, then we will see that slowly wind its way through the economy. It's just really slow. And it's very unequal in how the higher rates and the contraction of credit is hitting the economy.
So what I'm hearing from you is own U.S. big tech companies and chill. Is there some room for, say, T-bills or, you know, international or gold? Or do you just basically say you could have your general allocation overweight U.S. stocks, just keep there in particular the tech names?
So we allocate to all asset classes. On the equity side, we have favored U.S. and large for several years now because it seems very clear that potential growth in the U.S. is just higher than elsewhere. And even though we get better than expected numbers from Europe or even China, it's just not enough to really go where the U.S. can go in terms of sustaining growth. I mean, you're looking at policies that have to, boost growth there. So we've been U.S. large cap overweight for a while now. We're very comfortable with that, but we do allocate everywhere. In terms of the bond side, we've always said you've got to, actively manage your bonds. We never said go long duration. We said, please get out of cash because we think it's a year where cash can underperform. We think as rates move higher, it is a great time. As you said, why does everybody want to go into bonds when, when rates come down 50 basis points? Like maybe this is the time to start walking out a little bit. But you have to actively manage it. And we still want to start getting into those vintages.
And what about gold?
So I heard your gold conversation earlier. Look, gold can be a risk-off asset or a risk-on asset. It is not in our allocations. It has no yield. It has no dividend. Just very hard to track here. But I think here gold is as acting as a inflation, an expression of discomfort with possible inflation bumps.
Okay, well, there's a lot of discomfort. We're at all-time highs. Alicia Devine of BNY Mellon. Alicia, don't leave it so long next time. It's good to see you.
I would promise to be back.
Thank you very much. Appreciate it. Equities right now on the S&P positive by 0.2%. Let's get to your Bloomberg brief. We can do that with Yahara Hackers. Hey, Yahara.
Hi, John. The U.S. is set to place new sanctions on Iran after the country's unprecedented attack on Israel. National Security Advisor Jake Sullivan saying new measures will target Iran's drone and missile programs. And on Capitol Hill, lawmakers are debating legislation to place sanctions on importers of Iranian oil. U.S. home loan rates are climbing once again. According to the Mortgage Bankers Association, the contract rate on a 30-year fixed mortgage hit a 4-month high of 7.13%. Despite higher rates, the same report shows home sales actually increased 5%. That's the first gain in 5 weeks. Mortgage rates are at risk of rising further, with the 10-year Treasury yield now at its highest since November. And the SEC is cracking down on the use of third-party messaging apps on employee mobile phones. The agency is now restricting access to platforms like WhatsApp, plus SMS and iMessage. The restrictions are meant to help improve record-keeping and address potential security vulnerabilities. The SEC's Twitter account was hacked earlier this year through a staffer's agency-issued phone, which resulted in a fake post announcing the approval of spot Bitcoin ETFs. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, it's gold's shining moment.
Gold is a marvelous sweet spot. It's a very good diversifier and a very good hedge for paper assets. That started a lot of buying coming in the last couple of months and sent this market to all-time highs.
At all-time highs and why it could go higher. Citi looking for 3K. That conversation up next.
Elections kick off with a focus on the economy, social divisions, and climate change actions that will influence the global story. Bloomberg is live on location with the latest updates from the world's largest democracy. Coverage begins April 19th.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Equities right now on the S&P 500 positive by 1/3%. Yields are lower by a single basis point. Things are doing better. We're back to about 465.10. In the FX market, dollar's weaker, maybe steadying things. The epicenter of that calmness is coming from foreign exchange. The euro's a little bit stronger, 106.37 on euro dollar. Under surveillance this morning, it's gold's shining moment.
Gold is a marvelous sweet spot. You can be out of the dollar without actually being in another currency. Gold has proven to be a good asset to own during periods of elevated geopolitical risk. It makes it likely that not only would a central bank buy, but others would buy as well. It's a very good diversifier and a very good hedge for paper assets. That started a lot of buying coming in the last couple of months and sent this market to all-time highs.
Here's the latest. Gold hovering near record highs, up just over 15% year to date. Citi's Akash Doshi writing this: we project 3,000 an ounce over the next 6 to 18 months. The recent gold rally has been aided by geopolitical heat and is coinciding with record equity index levels, so a steeper risk-off environment should further boost prices. Akash is with us now for more. Akash, good morning to you. I want to talk about the drivers here, if we can start with that. Can you help me understand? Because typically we'd associate a gold move with a weaker dollar and lower yields. This is happening the other way around. Why is that?
That's absolutely right, John. If you look at the gold rally over the last couple of months, it's coincided with a stronger greenback, as well as a real backup in nominal yields, as well as treasury yields, real interest rate adjusted treasury yields. So I think a big part of it is financial flows are finally catching up to what's been strong physical demand, right? If you look at what's driving gold over the last couple of years, if I was sitting in the studio, Fed was at the zero lower bound. They were going to increase rates to 5.25%. No one would have thought gold would have averaged $1,800 to $1,900 an ounce, and then here at records at $2,400 an ounce. And I think a big driver is the official sector demand. It's been bar and coin demand from retail, very strong Chinese non-monetary imports, and I think that physical demand for alternative fiat, for reserve diversification in the official sector case, I think that's driving this gold demand on the physical side, and financial flows are only catching up.
That's interesting. Given the character of demand then, do you think there is no limit to the divergence we're seeing between, say, treasuries and gold at the moment?
I mean, the relationship is still there, but what we wrote in that note and what I wrote is that the duration has just shortened. So we think getting to $3,000 an ounce over the next 12 months is plausible if the Fed proceeds with, for example, insurance cuts, and nominal rates can still stay high, but then real yields would rally. If you have a turn in the dollar cycle, that would just be a kicker for gold getting even higher as financial investment flows come back into play. Also, given equities are at all-time records, or were in the past week or two, you also have potentially gold serving as a macro overlay hedge. So if you do get an equity correction or unwind, if the market is mispricing U.S. recession risk, then I definitely think gold is a good portfolio diversifier there.
Recently, in the past couple of weeks, we've seen a repricing in the bond market about the idea of higher for longer. And what we hear from institutional investors and even some executives is that it's a pet rock and that it doesn't give you anything and that there's no runoff, there's no yield. And if you go into T-bills, you could get 5% and you actually earn something. How much are you seeing institutions pull back as everybody else gets in?
Well, I think the inflows are coming not only just from retail, but it is coming from institution. And if you think about gold, yes, it is a non-interest-bearing asset. So the move in rates is not a positive tailwind. But what we're seeing is it's not a negative headwind right now either. And I think it's for other reasons. For example, the central banks are buying gold not for yielding, but because it's a bearer asset. So you don't have credit risks. It's an alternative fiat. So some of the moves that you've seen in crypto this year, part of it on ETF launches, some of that overcapacity is clearly shifting over to gold and silver markets. I think also from the point of view is, can you monetize gold? You actually can in the options market. You can hold gold and sell and overwrite volatility on that. And in fact, a lot of private bank, ultra high net worth individuals that own physical gold, they sell options in the market and they monetize the volatility skew.
Well, so this is actually exactly what I was going to ask. And forgive me for getting very basic, but I do wonder about central bank buying of gold. Do they just sort of store it there? Are they looking to monetize it through options? Do they have a gold carrier who they can call 1-800 monetize my gold, and they can go and deal with it? I mean, what's the functionality of gold in a central bank portfolio?
Central banks are buying gold, which is physical gold that's typically stored underneath the New York Federal Reserve in London vaults. Some might be stored onshore. and some might be stored in France, Switzerland vaults as well. It is physical demand. It's used as a reserve diversifier. It's used to as part of a broader de-dollarization theme, and it's dollar recycling, right? So as treasury holdings might go down incrementally, gold holdings go up. But guess what's a smaller market? Fiat market or the gold market? The gold market is much smaller. So even incremental demand pull from the official sector, which is now 25 to 27% of annual gold mine production, that is a big boost for prices in our view. And we think that set a higher price floor. So as $1,000 became kind of the new price floor post-financial crisis, I'm arguing that 1,900, even 2,000 could become the new base floor for gold going forward, and that we're in a higher for longer regime, kind of resetting price expectations over a structural period.
How much do you think U.S. sanctions are driving that appeal to gold?
I think U.S. sanctions policy has been a big driver. If I look at central bank demand trends, they started increasing post-financial crisis after being net sellers for 4 decades. In 2014, with the Russian annexation of Crimea, central bank holdings started to increase further. Then in 2018, with the U.S.-Sino trade spat, they started increasing further again. And then most recently, over the last 3 years, you've had record central bank purchases since the Russia-Ukraine war.
But these purchases, you say, are stored in places like downtown at the New York Fed or London. Is there a point where, if they're owned by that central bank, the U.S. could still maintain control of them?
Some of that has been onshored more by emerging market countries. Very difficult to track, but we do expect that trend to continue from many EM central bank players. And keep in mind, it's not just the PBOC and Russia that have been buying gold over the last decade. Yep. It's Poland, it's India. Even within developed market Asia, Japan and Singapore have been 2 of the largest gold buyers in the official sector sense since January 21.
You used the phrase that I think a lot of guests still shy away from. You said de-dollarization. Why are people so afraid of that phrase? What does that mean to you?
I don't think everyone is afraid of that phrase, but it is a concern for U.S. policymakers as people look for alternatives outside of the dollar. And if you look at Russian sanctions regime since 2022, gold as a bearer asset was the one instrument that they could hold, which they held onshore, that really couldn't be touched. Yes, you can push Russia out of the LBMA market and give them less liquidity to the Swiss refining centers, but they still have that asset, right? So I think from that point of view, challenging the U.S. dollar and the hegemony of the U.S. is probably a goal of some emerging markets, and we see that as a long-term trend.
Is there a limit to the amount of gold that central banks can hold on a relative basis to their reserves?
You'd have to ask central bank reserve managers. I think from that perspective, right now, the incremental gold holdings have grown. Right now, they're representing somewhere around 25% of annual gold mine production. As that number incrementally increases, that is price supportive. We think it does 2 things. It lifts the price floor of gold, and it damps downside price volatility. And that's why I think we're in a new regime shift, and dare I say, it could be a multi-year, multi-decade regime shift.
This conversation feels incomplete without introducing Bitcoin. Where does Bitcoin fit into this? Is it a competitor to some of the forces that you're talking about that underpin and support gold?
On the retail side, we see crypto as part of the alternative fiat story, particularly with retail investors. From a central bank or official sector standpoint, we don't view crypto and Bitcoin at Citi as digital gold. We view that as an alternative or a separate asset class. I think gold holdings increasing from sovereign wealth funds and central banks, what it does is it proves the validity of gold in the monetary system. And gold is old and traditional money. So we think crypto is a little bit newer. That's happening more on the alt-fiat side for retail. I think the official sector demand story is still driven by gold.
Is retail catching up to the gold story yet? Am I about to see tons of gold commercials, like we'll buy your jewelry, we'll buy your jewelry? How far away is that?
Well, it happens a lot on certain networks that you might not be watching late at night already, certainly maybe not Bloomberg. But within that context, yeah, I think so. I mean, you've seen the headlines about Costco selling out of gold bar and coins during specials, about young millennials doing stacks of gold bars as opposed to sat stacks on Bitcoin. So sure, I think it is becoming something that retail could get more interested in. Interestingly enough, John, ETFs have still posted outflows.
Interesting.
Since 4Q20, the all-time peak, You've seen 20 tons a month of ETF outflows on average. Imagine if that just flatlines or starts to increase. That tightens up gold physical, and I think that helps accelerate the move to $3,000 an ounce over the next 12 months.
I enjoyed this. We should do it again. A reference there to lowbrow financial news networks as well. Coming up next, Dana Peterson of the Conference Board. Their conversation coming up shortly. Akash, thank you. From New York City, this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West, only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
Was going to keep bringing World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people.
There's no question this industry is composed of some bad actors and some good actors.
The transactions.
Volumes have surpassed $24 billion per day.
And the technology.
Stop talking about the technology. Start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
Equities with a bit of a bounce going into the opening bout, 60 minutes away. Three-day losing streak on the S&P 500, positive here by a little more than 0.25% on the morning. In the Nasdaq, we're positive by 0.2%, and the Russell doing a little bit better, up 0.4%, but the Russell has been difficult since the highs of March. In the bond market, new highs for 2024 on a 2-year yield and a 10-year yield over the last few days. 465.52, really close to 470 in yesterday's session. Yields backing away just a little bit, down a single basis point on a 10-year, on a 2-year, down 2 basis points. 42. And Lisa, once again, breaching 5% in the last 24 hours.
There are people who are kind of circling to buy, but it seems like they're not showing up in force just yet because there isn't that conviction that inflation is really going to get under control. And underpinning that is this question of how much does the equity market have to crack to get bonds under control, to get inflation under control, to get the Fed to actually cut rates?
And how much does this dollar need to rally to cause some big problems worldwide? The good news for those of you worried about that is that on the session, the dollar is weaker against, I think, pretty much everything in G10. The euro is positive by 0.1% at 106.33. The yen is showing the smallest bit of yen strength against the dollar at 154.67. And cables at 124.50, positive by 0.2%. Earlier this morning, Lisa, as you know, inflation in the UK just a little bit hotter than expected, but still the BOE expected to cut sometime soon.
They don't have the luxury necessarily of allowing inflation to run hot while also supporting the economy, but that seems to be what they're working at right now, is that they're looking at a lot weaker growth and inflation, as we were pointing out earlier today, still below where we are in the U.S. So it might be hotter than expected, but still the U.S. is looking more inflationary right now than the U.K.
Yeah, and Europe and the UK, and you said it, just does not have the growth profile of what we're seeing play out here in the United States. That's the FX story. Under surveillance this morning, our top stories. President Biden calling for new 25% tariffs on Chinese steel. The move only targeting a small segment of the US market, just over $1.7 billion worth. Biden making a campaign stop in Pittsburgh today to reiterate his call for US steel to remain American-owned. We talked about this hours ago. This is messaging, and it's messaging for the campaign trail. It's messaging going into November.
Absolutely. This is on cue for November, not about how they feel about steel when it comes to putting steel in the United States, given how small and minute this is in terms of the demand. But this sets the stage for potentially what we're going to see in some of the policy levers the administration can pull before the election. So it's going to be these tariffs on China when it comes to steel. We're waiting on potentially more tariffs when it comes to EVs. And then, of course, the Strategic Petroleum Reserve. It's tariffs and potentially putting more oil into the market, keeping gas prices down, talking tough on China. In swing states, this is what matters.
So it is politics. It is ahead of the election, but it is also policy. And I really just, again, we talk about geopolitics. They are more and more intricately intertwined with the economic backdrop and this question of what do you want the economy to be? You talk about free trade, the idea that the U.S. is trying to say, okay, someone's not playing by the rules, so we've got to play by their rules, and we're going to adopt some of the same kinds of measures. And what that looks in a holistic policy level and how that does not contribute to inflation is something that's kind of this circle that we're trying to square.
Yeah, Lisa, I think you're absolutely right. I think what we've seen under this administration, and we saw it in the previous one as well, national security concerns, and they seem to cover a lot of things right now, seem to come before any economic ideas you have. It's been interesting to see the progress, the journey that someone like Secretary Yellen's been on, coming out of the Federal Reserve with very specific views, I would say almost establishment views, old school establishment views about global trade, having lower tariffs, to go almost in complete reverse, a full 180 for the Treasury Secretary to really put at the forefront of her concerns national security issues. And that's not what we heard at the start of her term at Treasury.
No, she's really started to migrate towards the Jake Sullivans in this administration. And I think the quote she gave to the Wall Street Journal before she went on that most recent trip to Beijing, talked about in the past, you know, you get something free or a discount, you'd send a thank you note. She says, I'm no longer sending a thank you note.
We'll hear much more from the Treasury through the week, of course. The IMF World Bank spring meeting is kicking off this week. Elsewhere, Boeing under scrutiny at two separate Senate hearings today, one including whistleblower testimony. Senators calling on safety experts to address gaps in the plane makers' assembly processes. Boeing executives won't be present at either hearing. CEO Dave Calhoun expected to testify at a later date. Talk about messaging and bad optics. That's coming up a little bit later.
Yeah, they don't have the current CEO there, and they're not sure who the future CEO is going to be. And as we heard earlier this morning, this is mostly theater at a time where there still are a lot of questions around what actually happened. Honestly, I'm actually more curious about what people are questioning them about in terms of what we don't know yet, given how long this has gone on and the fact that fact-finding should be kind of number one, and it's kind of amazing we haven't gotten further.
This is all going to be, as Sheila and you were talking about, backward-looking. Although I think a lot of senators are probably going to want to try to figure out who the next executive is to try to clean up some of this culture. But future-looking, Ryanair is talking about the fact that they said Boeing's taking steps to accelerate jet deliveries. So they're pretty excited this morning, if you look at what Michael O'Leary is talking about, that they're going to get 2 or 3 additional planes before the end of June. Pretty important for peak summer travel.
If you're scared of flying and you're flying later, maybe with Boeing, don't listen to that whistleblower testimony a little bit later today. The details of that It's pretty frightening when you go through the details of those allegations.
Yeah, just complete lapses. And safety protocol, we talk about new technology. How about the technology of tightening some of the bolts and making sure that somebody oversees that tightening? These are some really difficult moments for them. I think the takeaway for us who fly is that planes might be older. You might not have the same kind of capacity, and it's going to have a real ripple effect because Airbus can't reduce production quickly enough to offset what we see from Boeing.
Expecting a pretty strong defense to come from Boeing. Once you hear more about that a little bit later. Elsewhere, Fed Chair Jay Powell putting rate cuts on ice. Powell saying yesterday, quote, "The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence." Today, we'll get more Fed speak, Mester and Bowman, plus the Beige Book coming this afternoon. Joining us now to discuss is Dana Peterson of the Conference Board. Dana, last time we spoke, we talked about CEO confidence and the survey that you do, and I want you to help us understand whether those CEOs are moving away from hoarding and towards layoffs, or whether that's changing.
Well, we haven't had an update since the first quarter. We will get another one in a few weeks, but in that data, it suggested that, yes, there was a move upward in the number, or at least the percentage saying that they were looking to lay people off from 13% to 23%. That's a 10 percentage point differential, so that's pretty significant. But we still see a lot that are hoarding. So the key thing will be whether or not CEOs still think that there's something bad headed for the economy. But certainly they're still complaining about labor costs being elevated and the concerns about having to raise wages to hold on to workers and also to attract new workers, especially in those sectors that are experiencing labor shortages.
These are really important conversations for a whole host of reasons, including consumption. Let's turn to consumption. Dana, can you talk to us about what is underpinning consumption and how sustainable you think some of those trends are?
Sure. Well, definitely seeing that goods consumption is starting to weaken. Even though the retail sales overall were elevated, most of it was in prices. Take away the prices, in real terms, retail sales are actually down in the first quarter. But that's still not affecting services. Consumers are still willing to spend on vacations and various types of items. The interesting thing, though, is that they do desire to shift services consumption more to things that they need, like health insurance and car insurance, and less towards those highly discretionary activities like entertainment outside of the home. But still in all, what's underlying consumer spending is the fact that they're working, they're still fairly optimistic about the current situation with their jobs, and many of them have seen wages rise, and also lots of them are still using those credit cards and buy now, pay later schemes to finance their consumption patterns.
Dana, how much has the strength in equity markets, in bond markets, fueled some of the consumer spending?
Well, most consumers don't own any equities, but they do kind of internalize what's happening in the equity market for themselves. They see that if the equity market is doing well, most likely they're going to continue to be working, and that's going to continue to allow them to spend. Even if it's not out of earned dollars and they're putting it on credit cards, they still believe that they'll have the capacity to pay back that debt. So certainly a better equity market and continued gains does support consumer confidence.
The reason I ask is because people have been talking about the pivot back in October, November, December by Fed Chair Powell, talking about the potential for cutting rates, really keying off this latest bout of strength that has persisted and really caused and allowed inflation to remain higher for longer. Do you adhere to that view that essentially it was the Fed's pivot back late last year that has allowed inflation to remain as hot as it has and allowed consumers to keep spending as they have?
Likely not. When we ask consumers what they're planning on buying, especially big durable goods that you need to finance, they're not really excited about it. They're buying fewer homes, cars, appliances, even things like cell phones. Certainly when the Fed pivoted and said, look, we're done raising interest rates and we're looking, the next action will probably be rate cuts, you did see mortgage rates fall. But since then, mortgage rates have picked back up, and certainly we're not seeing broad-based consumption of housing. It's really on the margins and mostly for new homes, but existing home buyers are still on the sidelines. So I don't really see that the gains in inflation are because of the Fed. Indeed, when you look at what's driving inflation, or at least keeping it sticky, a lot of it's supply side factors like food and energy prices. Also the fact that insurance companies are raising their premiums, and that has to do with technology changes and also climate issues. But really the big portion of inflation is housing and shelter costs, and that's continuing to slow year on year, and the Fed did have a role in that. So I would have to disagree with the thought that the Fed pivot, quote unquote, back at the end of last year is causing inflation to be stickier now.
There's also this question of the overlay and the overhang of oil prices and oil at a time when we're potentially heading into the busiest driving season as well as the busiest geopolitical cross-current moment that we've seen in a very long time. How are you factoring in gasoline prices in the U.S., the highest levels going back to October, the fact that we're seeing oil prices hover around $90 a barrel, this idea that it could reach $100 a barrel? How are you gaming this out with respect to confidence, but also just corporate activity?
Well, we have to raise our inflation forecast for the headline because this is a classic case of insufficient supply and emerging demand. We're heading into the peak driving season in the U.S. Meanwhile, OPEC Plus has pulled back on production. In the U.S., we're having issues with shortages of energy, certainly in the strategic oil reserve. And also, when you think about the energy sector, there's not much investment going into fixing refineries. And so a lot of things are breaking, a lot of the equipment's old, and that's also affecting supply. So when you put these things together, it suggests, yes, we are going to see higher gasoline prices over the next few months, and we're going to have to factor that into our forecast. The question is whether the Fed looks through that. And I think the thing is that the Fed really can't look through supply issues anymore because supply has been such a big factor in what's been driving inflation, even away from the interest rate hikes that they've implemented that have helped to affect the demand aspects of inflation.
How much is geopolitics and all of this risk weighing on executives?
Oh, it's definitely an issue. In our CEO confidence survey from the first quarter, the thing that they thought was the most strenuous or the worst risk for both the global and the U.S. economy were geopolitics. And it's the uncertainty around that. And indeed, how these things will affect supply chains, prices for inputs such as chips and energy. And these things are really causing our executives to be very worried about the future and potentially causing them to kind of resist big investments in areas that they don't think are going to be very productivity enhancing.
You question whether or not the Fed can look through the spike and the rally we are seeing in commodities, specifically the oil market. What is the gap? How much is it in terms of, say, $10, $20 on Brent that they actually start to get very concerned?
Well, I think the Fed's concerned now. Certainly, Chair Powell said yesterday, look, we may need to wait longer for that quote-unquote confidence and suggest that, well, maybe 75 basis points of cuts are really not feasible for this year. So I think the Fed is already concerned about this. They're looking ahead, and they're saying to themselves, it's not really clear that we're going to see the constellation or the perfect constellation of data that will allow them to have that confidence to start cutting interest rates before sometime in the summer.
Dana, this was great. When the new survey comes out, let's catch up. Looking forward to that. Dana Peterson there at the conference board. Appreciate it. Thank you. This from Citi's Andrew Holmhorst. Moments ago, Powell wants to cut. Here's a line. Interesting take. Just 40 basis points of cuts priced for 24. Underappreciates that the Fed is poised to cut rates on either slower year-on-year core inflation or any signs of weakness in activity data.
So basically, see that bar? Let's lower it here.
Yeah.
Now let's lower this here. Hey, it's down there. That's fine. We can cross it. That's essentially what you're saying. And frankly, that coheres with the pivot. I go back to Alicia Levine. Can he pivot from the pivot? It makes a pretty awkward situation.
I found it difficult to keep up, but it's sort of later in the morning. But yeah, I get it.
It's like,
pivot from the pivot.
Yeah, pivot, like you had to get back and up and,
Got it.
A pivot is a U-turn, no?
That's what I thought too. Why don't we just call it a U-turn?
Well, it's because it's sudden and it's sort of jarring to the markets. Okay. U-turn is sort of a very deliberate kind of act.
Right, and this, okay, all right. Let's get you the Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. Tesla will ask shareholders to vote again on its compensation package for Elon Musk. This after a court in Delaware voided the $56 billion payout arranged for the company's CEO back in 2018. In a proxy filing, Tesla also said it will also call for a shareholder vote on moving the company's state of incorporation from Delaware to Texas. Senator Bob Menendez is preparing to blame his wife at his bribery trial. Court documents show Menendez will claim his wife Nadine withheld information from him about gifts the couple allegedly accepted from businessmen and the Egyptian government in exchange for favors. Menendez's legal team is trying to get a judge to try him and his wife separately. In an interview with Bloomberg, JP Morgan Chase CEO Jamie Dimon makes no secret that his firm is all in on artificial intelligence.
It's a living, breathing thing. It's going to change. There are going to be all different types of models and different types of tools and technology. But the way to think about it for us is every single process, so errors, trading, hedging, research, every app, every database, you're going to be applying AI. So it might be as a co-pilot. It might be to replace humans. Like, AI is doing all the equity hedging for us for the most part. It's idea generation, it's large language models.
You can see more of Emily Chang's interview with Jamie Dimon on The Circuit tonight at 6 p.m. New York here on Bloomberg Television, or stream it at 8 p.m. Eastern on Bloomberg Originals. That's your Bloomberg Brief. John?
Hey, Yahara, thank you. Congrats to Emily again. That's a must-watch a little bit later on. This from Dan Ives of Wedbush this morning on Tesla. Yahara was talking about it. In our view, the clock has struck midnight for Musk to now lay out the growth strategy, give realistic delivery and margin goalposts, discuss why significant layoffs now, and most importantly, give a clear outlook to the street around Model 2. He's been talking about this inflection point for Tesla for how long now? He's still got an outperform on the stock.
Well, this is the reason why I'm wondering, is this inflection point the one where he's going to say, I no longer am bullish on this stock if you don't deliver?
After a 30-plus percentage point move so far year to date, I mean, how much more do you want to see?
Well, and this is the question. This is their moment. It's midnight. Well, what comes after midnight?
I'm pretty sure it's gone midnight. I mean, he's been talking about midnight now for 6 months, hasn't he?
Come on the show, Dan, and we'll talk about it.
We'll talk about what time it is. Tesla right now positive by 0.6%. Up next on the program, President Biden's latest pitch to U.S. workers.
This isn't a level playing field, and when the markets weaken, prices fall. It's our firms that go out of business.
That conversation just around the corner. Your opening bell is about 43 minutes away. Equity futures positive by a third of 1%.
On season 2 of The Circuit, we're walking with the titans of banking.
Hello. You guys love these meetings.
Yes, me too. And driving a warship through the Pacific.
You're not the typical Silicon Valley founder wearing a black turtleneck. Like, how does that play?
I am a little bit of a caricature.
Taking you around the world.
So we're kind of in the middle of nowhere. It's incredible that this is the site of the biggest Netflix production ever in Latin America.
And getting you closer to tech and business leaders like never before.
You have our money. You've got more leaders on speed dial. That's a lot of power.
Sometimes I think I'm just riding the Bronco and hanging out for dear life.
You driving a Hummer is pretty badass.
That's what I'm going for, like badass soccer mom.
I'm Emily Chang, your ticket to the front lines of tech, innovation, culture, and host of The Circuit. Wednesdays on Bloomberg Originals and Bloomberg TV.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you got to be smart about this.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Things are better. If you thought it was a problem that crude was higher, it's lower this morning. We're down 1% on WTI. WTI right now 84.44. If you were worried about higher Treasury yields, they're a little bit lower today, down 2 basis points, 464.48. And if you're concerned about a rip-roaring dollar, that's a little weaker. The euro stronger, 106.37. These are mild moves, Bramo, but certainly moving in a different direction compared to what we've seen dominate the last week.
It's snoozy. No one has new information to do anything with this morning. Essentially, that's what we're looking at after a reset yesterday and a reset the day before, and that's what we're feeling right now.
I'll take snoozy. Just a break sometimes, a good thing. We all need one. Under surveillance this morning, President Biden's latest pitch to U.S. workers.
This isn't a level playing field. And when the market's weak and prices fall, it's our firms that go out of business. Chinese firms continue to receive support so that they remain in. From a supply chain standpoint, I think it creates risks that we're clearly seeking to mitigate, and it's also unfair to our workers and firms.
So here's the latest. President Biden proposing 25% tariffs on Chinese steel and aluminum. The news coming ahead of his visit to Pittsburgh this afternoon, where he'll meet with workers and reiterate the U.S. steel should remain American-owned. Joining us now is the brilliant Mario Parker of Bloomberg down in Washington. Mario, let's talk about that visit to steel workers. What can we expect to hear a little bit later?
We're going to hear, John, a whole bunch of a heavy dose of populism, right? This was a signal ahead of that visit to herald to steel workers that Biden is there for them, that he's pro-union. A popular refrain in his stump speeches is that he's the most pro-union president in U.S. history. But we know that he faces a tough slog with the rank and file with his political rival, Donald Trump, really appealing to that demographic.
Mario, we know that Catherine Tai, the U.S. trade ambassador, is nearing completion of the statutory review of the Trump-era tariffs. We all agree around this table, and I'm sure you do in Washington, that this is purely political when it comes to what Biden is going to be doing when it comes to Chinese steel. Would we actually see it come to fruition before November 5th?
We may, Anne-Marie, and we're on high alert just for the outcome of that investigation there with Catherine Tai. But no, we're on high alert for that here in Washington, D.C. I mean, listen, what we're seeing right now is just the landscape of the 2024 election. There aren't many, to your point, there aren't many Chinese steel and aluminum imports coming into the U.S. relative to previous years because President Joe Biden kept Donald Trump's tariffs in place, largely kept those in place. So what you're seeing is him essentially squeezing the lemon here for whatever modicum or small amount of imports still exists. But also, similarly, he's squeezing the lemon there because he needs as many votes as possible in a crucial swing state like Pennsylvania.
But there's also going to be potentially more sanctions, not tariffs, but sanctions when it comes to Iran. We heard from Jake Sullivan last night talking about the United States is looking at what more they can sanction. Mario, there's a statement there. What could the U.S. sanction? This is one of the highly sanctioned countries in the world. More they can sanction. Mario, there's a statement there. What could the U.S. sanction? This is one of the highly sanctioned countries in the world.
Yeah, well, you're saying Sullivan say that essentially they're going to target the missile apparatus, some of the aircraft that was used, the technology behind the aircraft that was used in the drone attack that the U.S. largely helped Israel thwart and its allies thwart last weekend as well. And so you're saying them kind of target that specific sector. But to your point, Anne-Marie, similar to the other subject that we just mentioned, I mean, Iran is already heavily sanctioned.
Mario, to that degree, we're hearing from Israeli Prime Minister Netanyahu this morning. Thank you for the suggestions, but no thanks. We'll take care of this ourselves. How much are you seeing an ongoing breach that actually does have some consequences from the United States against Israel if they do go after Iran more directly versus a bit of a walk back from the administration over the past couple of days?
Yeah, well, we've seen the administration quite publicly put pressure on the Netanyahu, some of his leadership, just asking for cooler heads to prevail, essentially saying, okay, we were able to thwart this attack. Let's not escalate things in the region. Now, to your point, I mean, the frustrations between Washington, the Biden administration in particular, and Netanyahu are, you can't really overstate just how tense those moments are right now.
Mario, I appreciate the update, as always, sir. And we'll see you a little bit later in Washington, D.C. Mario Parker there of Bloomberg. In the nation's capital, coming up tomorrow, live from the nation's capital, special Bloomberg surveillance over the next couple of days at the IMF World Bank spring meetings. We'll kick it off with Alifa Doriwala of Rock Creek, IIF President Tim Adams, Klaas Knot, the President of the Central Bank of the Netherlands, and IMF Managing Director Kristalina Georgieva. Later on in the week, we'll be speaking to Catherine Tai herself, so a lot to talk about on trade. And Lisa, I know you're catching up with Gita Gopinath of the International Monetary Fund.
They did upgrade their growth forecast going into this with a whole host of risks coming around this. To me, I'm actually very curious how they view an economic regime so heavily influenced by politics, where suddenly this is a multipolar world, as we've been talking about extensively, where economic policy is political policy, is geopolitics, and does not look like the free trade of the past.
Also, a very strong criticism from the IMF when it comes to the United States and their fiscal health of this country. Yes, all the fiscal money coming out the door potentially helping with American exceptionalism, but are they ever going to deal with the debt problem?
Time to get to the train station, isn't it? You know, we're all going together.
Okay.
No?
Only one of us is taking the train.
Okay. What are you talking about?
Me
Always
too.
Get the train.
Me too.
They're not.
Always get the train.
They're lying to you.
Why would we lie about it?
John and Lisa are lying. I'm the only one that's
I
taking
always
the
get
train.
the train. I'm very sort of pro saving the planet and getting the train down to Washington.
Is that your theory?
Yeah.
You know, actually, it's always a toggle for me. It saves an hour, but if everything goes wrong, which is more likely to do for a plane, I don't know. These things are not really.
I don't like how transient trains are. You know, if I'm really honest. You know, people getting on and off. Just like, you sit on a plane, get to where you need to go, get off the plane.
So you want to get used to everyone around you, so that you just you're trapped together for a certain period of time.
Are you flying window or aisle?
No, I'm pretty sure I'm aisle.
Lisa?
I think I'm aisle.
I don't know. I'm not keeping track. I'll see you tomorrow in DC.
Transient trains a thing, you know, like you like
I like
on
it.
and off.
I think it's good color.
So you've got one eye in your bag, just making sure the bag's
It's new
not being
ideas.
stolen.
Oh my God.
You know,
really?
It's rough out there.
Oh, give me a break.
It's dangerous.
It's ridiculous.
You've got to be careful. People steal your bag.
Who are you?
It's a real thing.
Has that happened to you?
Train theft is a
Have you ever had something stolen?
No, because I keep an eye on my bag.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The linear business is not going anywhere. The sports business is moving and is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to be. Every single one of the players want to be in it because of the audience. We have two assets in the sports business that are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder programming.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long tail. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal?
The deal?
The Deal. The Deal. That deal. The Deal.
Huge deal.
Who dug this up? What are y'all in trouble?
Wow.
From New York City for our viewers worldwide, I'm Danny Berger in for Jonathan Farrow. Stability, finally. After 3 days of selling that push equities down 4% for the month, front-end yields touching 5%. We're calm now. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Farrow.
Coming up, futures edging higher after 3 days of declines. Sentiment improving as earnings take center stage and yields retreat from their highest level of the year. We begin with the big issue, Chair Powell signaling higher for longer.
We'll need greater confidence that inflation is moving sustainably toward 2%. The recent data have clearly not given us greater confidence and instead indicate that it's likely to take longer than expected to achieve that confidence. Right now, given the strength of the labor market and progress on inflation so far, it's appropriate to allow restrictive policy further time to work and let the data and the evolving outlook guide us. The performance of the U.S. economy over the past year has really been quite strong. Come what may, we remain strongly committed to returning inflation over time sustainably to 2%.
Let's get to Ira Jersey of Bloomberg Intelligence for more. Ira, yields have already been moving higher before Chair Powell spoke. 40 basis points higher for the 10-year in just this month alone. So what changes for bonds, if anything, to have a Chair Powell who's clearly less confident on inflation's trajectory?
Yeah, Jay Powell yesterday was as explicit as he's been, saying that we're not going to be cutting interest rates if inflation remains above our target and the economy remains reasonably robust. And, the market was starting to price that, as you noted. And I suspect that that he'll be even more explicit in the next 2 weeks when we get the next FOMC meeting. And I also suspect them to, there's no summary of economic projections at this meeting, but I think that they'll guide toward the idea that, hey, we're not going to be cutting unless we see significant changes in the economy at this point. And the market's starting to price for that. In fact, the market's pricing almost a 30% chance of a hike later this year. I don't think that that's going to come about, but the chances of them just being on hold the rest of the year are way higher than they were 3 months ago when we were pricing for 6 or 7 rate cuts.
I guess this is the thing, Ira. The market moved before Powell. Powell is almost a lagging indicator at this point if the market is already pricing at a 30% chance of a hike. So if we get the next meeting, as you say, and they are delay, does the bond market have further to move?
Yeah, it could have further to move, and I think the 2-year yields could move up just a little bit more, maybe to about 5.15%, because at some point the market's going to continue to price for the Fed to cut at some point. It's just that they might not start to cut until 2025, and then if they do, maybe it's not that severe, and because of that, the bond market's going to adjust for that. The other thing about the long end of the yield curve is, could you see 5% again? The answer is probably. Particularly if the Federal Reserve is much less dovish than it has been in the recent past. There's still a lot of forecasters who think that we're going to see significant slowdown in the second half of the year, so maybe we'll get a cut come September, November, December. But again, if we're waiting until we cut, then the certainty of that cut goes way down, and that's why the bond market has to adjust for that. And you've seen a lot of it, right? There's no doubt about it that the losses in the bond market have been pretty severe. To rally the long end of the yield curve in particular, you will have to see some form of economic slowdown and weakness that generally will lead to slower price growth, so somewhat lower inflation.
The irony of wanting a worse economy, Ira, is it's not lost on anyone for this bond market. In the short term, though, we get the beige book out later today. The bulk of the economic data was last week. Are there any real catalysts at this moment, or is it more of a sideways trade?
Yeah, I think that we're going to find new ranges for a lot of the bond market. Maybe not the 2-year note quite yet. Depends on what the Beige Book says. Beige Book usually doesn't move the bond market very much, but it does inform the discussion that the Federal Reserve is going to have at its next meeting. So, we'll be looking for any significant shifts. I suspect that it'll be a mixed bag with some districts doing pretty well and having modest growth, and then others saying that there are, some cracks. There are some areas of the country where, the job market's not as strong, and then others where it is still pretty robust. So those nuances and the regional differences are always something interesting to look at in the Beige Book, but tends not to be very market moving, at least on the face of it.
Ira, appreciate your time. Ira Jersey of Bloomberg Intelligence. Let's continue the conversation with Franklin Templeton's Sonal Desai and Nomura's Matt Rowe. Great to see you both this morning. Sonal, as we were just saying with Ira, it is a perhaps long time coming of a repricing this market. Let's be honest, we had a ridiculous amounts of cuts priced into the bond market to start the year. We've phased that out. Even Jay Powell is needing to admit to himself that maybe they're not going to achieve as many cuts as they want. So are we done yet? Or is there still more work to do in this bond market to price out further cuts, maybe even more hikes?
So I think actually the issue of hikes, it's a low probability event. We really need to have a significant reacceleration rather than stickiness, which is what we're seeing right now. We're seeing stickiness at an uncomfortably high level, and therefore I'm not ruling it out, but it's not my baseline in any way, shape, or form. I think 1 or 2 cuts are still quite reasonable, and I think at this stage it behooves the Fed to not talk the market back up, because that's one of the biggest problems we've had so far. And yes, Jay Powell yesterday definitely went a long way towards essentially following the market, as you said. I would say that we probably need to see a continuation of that, because it's clear that the Fed doesn't have that good an anchor on inflation yet as it would like to or need to have aggressive rate cuts.
That's a great point, Sonal, because we've seen that before from Powell, haven't we? It's almost this accidental dovishness that slips out and allows the market to rally. Matt, what say you? Is the U.S. bond tantrum over? Have we priced out enough cuts at this point?
Yeah, I think the market is getting used to the idea of a potential higher for longer state. And a lot of the equity markets rally was driven off of a hope that we would revert to more accommodative policy into that, that steady stream of rate cuts, which is now being pushed back at best. I don't think that this story is over by any means. There's a complicating factor of it being an election year. And there are stubborn aspects of inflation, as Sonal mentioned, like insurance costs for real estate, like the cost of crude oil, that have an inflationary impact on the market that is somewhat outside the control of the immediate policy decisions.
Of course, the complication of that in a world where inflation is still higher, plus an election, as you mentioned, Matt, plus geopolitical concerns, is where do you hide out? You certainly can't do it in bonds, as we've been discussing with the tumult there. You can't really do it in the yen, considering the sort of dynamic the BOJ has to play out with. Sonal, does that leave us with just gold?
I'd say that there have been years where I've thought about gold as a good hedge for inflation, but I would have thought that would have made more sense when inflation was really high. Right now, I don't see it that much. I would actually say we take a deep breath. We continue to be relative, clearly there's a lot of cash on the sidelines and it's earning well. I think you go towards ultra short in terms of duration, but be prepared for the fact that the market tends to overreact in every direction. And as we get closer to the end of the year, we probably will see a rate cut or 2. And I tend to be less of the view that it can only happen in December or September. You could have it in November. It's a couple of days after the election. The election's done. I think if the Fed focuses on the data, the Fed will cut when it feels that it has the ability to do so. I do think that the actual cutting cycle is going to be far shallower than the market hopes for. So it's not just delayed. I think it's very shallow.
So what needs to change if it is shallow? What's mispriced right now? Is it equities, for example?
Well, probably. I would say right now, maybe, I'm not an equity expert, so I'm not going to stick my neck out too far here, but equities definitely are not pricing in the idea, if equities at this point are pricing in a protracted rate cutting cycle along the lines, taking us back to the type of rates we've observed for most of the post-global financial crisis period, I think that would be a mistake, because I think that neutral Fed funds is definitely closer to 4 than the 3 to 2.5, 3 that the Fed currently is looking at. And if they're looking at 4, it has a meaningfully different impact in terms of what equities are pricing and where we should see 10-year yields over the medium term.
Matt, let me bring you into this. What do you think of this idea that we're really underprepared at this moment, at least from a risk perspective, that the cutting cycle might be shallower than we're used to?
Yeah, I mean, I would take a more definitive stance on this, that I do think that equity is overvalued, and it's a lot of the hoped for rate cuts are priced into that valuation. So there's a little bit of a tension between those two things, and I think that the whole point of cutting rates to zero is to push investors further out in the risk spectrum. They got comfortable with being long equity risk premia in multiple forms, including selling volatility on indexes and things of that nature. So we should start to see more of a pullback from that risk attitude. When you look at the valuations on equities, you look at the geopolitical situation, we have earnings just kicking off right now, and we have uncertainty where inflation and rates are concerned. And there's an unfolding story in the European high yield market right now that I think is pretty underreported. So I like being long equity volatility strategically and in the right way as a risk mitigation tool, and I like being long credit, newer vintage credit in the right way. You can think about it as a long short volatility trade, right? Like being long credit is a short vol trade where you're being compensated in the form of interest and accretion, but you need to have some sort of ballast to that trade. But I don't like equity. I think it's inflated across the board.
If you don't like equity and valuations need to catch up with fundamentals, how much worse does it get, Matt? What to you would be, all right, that's a fair valuation. How much lower do we need to get?
Well, I mean, you can look at year to date as an interesting barometer for how much of a rally this year was driven by a hope that we would go back to some form of cutting rates. Now it's somewhere between like 8 and 10%, I would say, at the S&P level. Obviously, the Russell 2000 has taken more pain this year and this month in particular. It's down about 6%, if I remember correctly. The Russell 2000 is more credit sensitive. They're more sensitive to cost of capital. They tend to borrow, and when they do borrow, they borrow at higher rates. So the impact of a higher cost of capital is going to be disproportionately negative on those that have a higher cost and those that are more reliant on it. A lot of the present value of anything is equal to the future value if the rate is zero, and then you start taking rates up and you start seeing the discount rate flow through the model, and it doesn't impact everybody equally.
Matt, I got to be honest, in this day and age, it feels like a lot of people have left their Finance 101 textbooks at home. So thank you for reminding us how we discount future cash flow. I think we all need that lesson. You both are going to stick with us, Sunil Desai and Matt Rowe. Okay, let's look at some of the stocks now that are moving ahead of the opening bell. Here's Abigail Doolittle. Hey, Abby.
Hey, Danny. Well, we are looking at the possibility, as you mentioned earlier, of a first up day in 4 days. And a piece of that, United Airlines up 6.5%. They put up a much narrower loss in the first quarter. Their revenue was better. But the real news is the fact that their profit forecast for this current quarter is better than what the street has been estimating, and easing concerns around any possible impact or fallout from Boeing. Take a look at Alcoa, up nearly 3%. The quarter wasn't great, but the stock is higher on reports that President Biden may call for higher tariffs on steel and in aluminum. And then finally, Children's Place, the small cap stock, it is up 25% on the news of a fresh $90 million in funding from a Saudi investor to strengthen their liquidity position. There is a stunning 54% short interest on that stock, Danny. I'm guessing that much of that big move up on Children's Place has everything to do with that short interest, a short squeeze.
Abigail, appreciate it. Abby Doolittle there. Okay, coming up, President Biden makes his pitch to steelworkers.
I think a good deal of what you're going to hear in that regard over the next coming months is, in fact, tied to the election cycle in the United States. Once we get through that, I think that there will be a possibility of the two sides finding their way to a better modus vivendi.
Modus vivendi. You don't hear that enough, do you? The president calling for higher tariffs on Chinese steel and aluminum. That conversation still ahead on Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
It's an incredibly fun job, for sure.
We're in the business of leading beyond the numbers.
To me, teamwork is key. You need to identify opportunities and push people. It's not about how to say no, it's about how to say yes.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
Today's CFO has to be much, much more than a bookkeeper.
I talk more about culture today than I talk about numbers.
It's not just about debits and credits and digits and dollar signs.
It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. New episodes this summer, only on Bloomberg. Brought to you by Workday. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
There are clearly going to be no-go zones in the relationship over everything from Taiwan to South China Sea to military competition itself. But I think the possibility of continuing to have coupled economies and not stagger into a decoupling of these two massive economies, I think I'm cautiously optimistic we can work through that after the election.
The White House is targeting Chinese steel and aluminum. President Biden calling for higher tariffs on certain products as he looks to shore up the U.S. steel sector. Leo Brainard, the National Economic Council director, saying, quote, "We must invest in American manufacturing, but we also have to protect those investments and workers from unfair exports associated with China's industrial overcapacity." Joining us now for more is Bloomberg's Anne-Marie Hordern. Anne-Marie, Biden is going to be in Pittsburgh pitching this. What are we expecting to hear?
Well, that's exactly why you're probably hearing such a policy like this, because he's going to be in Pittsburgh and because he's going to be talking to steel workers. This is, really a pivotal state for this election when it comes to union workers. It's almost like they decided to have an election visit and then decide what the policy is going to be because of how small Chinese imports of steel and aluminum are in the United States, about $1.7 billion worth in 2023. This is a very small market. But of course, you're going to see from now until November a lot of policy levers that the president can really lean on to probably tap into some parts of the electorate that he is trying to shore up. So today we're going to be talking about steel tariffs on Chinese aluminum and steel. Then, getting closer to the election, potentially, Danny, we could see things on like tariffs on China EVs. That's been a big discussion. And really what we've seen, whether it's Secretary of Treasury Janet Yellen in Beijing, or I had a conversation yesterday with the White House's John Podesta, it looks like they're getting ready to pull that next lever.
Anne-Marie, appreciate it. Anne-Marie Hordern there, who's on her way after this to D.C. at the IMF. Safe travels, Anne-Marie. Sonal Desai and Matt Rowe are back with us. Well, look, we already talked about this idea of election risk. But in terms of the actual contours, Sonal, if I can start with you, the contours of different policy, of what might be threatened in terms of tariffs, in terms of taxes, anything that might impact the market, is it too soon to trade it?
Mainly because the election is really close as far as the polls seem to be. In terms of the 20,000 foot up in the air picture, I really don't think there's much to choose from the perspective of the fiscal deficit, which I think is going to be large in either case. So it's unhelpful from the perspective of issuance. But from the sectoral perspective, there are clear differences in energy policy on the side of a prospective second Biden administration or a prospective second Trump administration. Similarly, on everything to do with renewables, you would likely see differences in these areas as well. And as we get closer and the two teams start talking more, we will get greater insight. One thing which is true, though, on the issue of tariffs, we hear a lot of fear about the talk on tariffs, But honestly, during the first Trump administration, a whole bunch of tariffs got laid on, and none of them have really gone away. So again, I don't think there's very much to choose between these two political parties.
Yeah,
They're quite
and
popular.
no, and things like attitude towards China, which goes hand in hand with the tariffs, all those things.
Absolutely.
Yes, Matt, what say you on this?
Well, I think it's hard in an election year, again, because a lot of things are said when running a campaign that are trying to feel out the audience and sort of find their way toward a policy that's going to resonate with their base. So without taking sides one way or another, I think it warrants caution during an election year to trade, as you mentioned, or position based on discussions about policy, because a lot of things are tested in the discussions and in the debates publicly going into it. We look more towards hard catalyst things like, if you remember back to the Section 301 tariffs that were initiated, there was a hard set of dates that you could quantify, and then you could take action on because you knew that there was an actual policy in place and how things were going to shake out. So I personally, think tariffs are an interesting tool, and they've been used throughout time, and they obviously can have an inflationary impact in the immediate on domestic, the domestic use. But they're a very important tool, and as we're moving towards a more fractured global environment where globalization is kind of going in rewind, I think these things are increasing costs in a lot of places that aren't terribly surprising. We've seen them before. They're likely to continue. So we look at it cautiously, especially in an election year.
And it's yet again, Matt, one of these contributors to inflation that I don't see how the Fed not cutting sooner is going to fix. Things like that, right. Things like immigration. So if we're stuck in this environment, Matt, where that sort of stuff is going to continue to be a pressure on inflation, are we living with higher inflation for longer?
I think so. I think we're going to be living with slightly higher inflation for longer because a lot of the aspects are outside the control of fiscal and monetary policy, or at least direct control. I also think that this is one of the reasons why I think that volatility is mispriced in the market, because when you look at volatility as evidence or a barometer for certainty or comfort, there has been a lot of confidence and a lot of comfort, but at the same time, we've seen a very, very high degree of dispersion. So that meaning that, a lot of companies are going up, at the same time, a lot of them are going down. The net effect has been a glide higher in the market. That could very easily tip to the other direction, where you start to see these aspects of the market impact equity in particular.
Well, Matt, just to change tones here, because Sonal, I'm not going to ask you about the equity story, because I know, as you say, you're not an expert. Although, I'll be honest, you sure sound like one when you talk about equities. In terms of just positioning and what the tipping point might be. I mean, we have seen this really big buildup of people getting more bearish on this treasury market. Yes, I know that those inflation dynamics are there, but quickly, Sonal, unfortunately only about 30 seconds here, but are the yields tempting at all?
They're beginning to get there, but I'd say that that band is really 575.5, and then I think technicals on the other side will start coming in to make it less attractive. So, yeah.
All right.
Getting closer.
Getting closer. At least we're making progress in some direction. Thank you both very much for joining us, Sonal Desai and Matt Rowe. Appreciate your time this morning. Coming up, we're going to get you your morning calls, and later, futures rebound after 3 days of declines. Better than expected earnings boost sentiment ahead of the opening bell. That conversation still to come. This is Bloomberg.
Fixed Income Fix. Watch Bloomberg Real Yield at its new time, Friday at 12 p.m. Eastern, right here on Bloomberg. Context changes everything.
always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. How has that shaped your strategy for the bank? Is this a new normal? Is this like a catalyst? Do you think we're in a new phase for dividend policy overall? That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Time now for your morning calls. A look at some of the analyst recommendations on Wall Street this morning. First up, TD Cowen upgrading e.l.f. Beauty to buy. They highlight the recent product innovations and effective marketing strategies. Next up, Mizuho initiating coverage of Royal Caribbean with a buy recommendation. They see potential upside to upcoming earnings estimates. Finally, Jefferies downgrading Urban Outfitters to underperform. They point to weakening traffic trends and mounting competition. Meanwhile, it is calm for this equity market. Finally, after 3 days of losses, we're headed down 4% for the month so far. A difficult trading session, but today it gets easier as we expand in terms of earnings. The banking stocks, the big banks are done. We go to the smaller banks next. We're going to break down all the stocks moving on earnings this morning. That conversation coming up on Bloomberg.
Look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing. But what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
It's the countdown to the open. I'm Danny Berger in for Jonathan Farrow. Just moments away to the start of trading, and we're on better footing this morning than we have been all this week. S&P futures up nearly 0.5%. NASDAQ not doing as well, but just a little bit up, 0.4%. Finally, a breather. 3 days of brutal selling based off of higher yields. Front end goes to 5% off the back of hawkish speak, and that pricing out of rate cuts. The things that did the worst are doing the best this morning. Russell 2000 up 0.7%. We're also getting a breather in this bond market. The selling turns to buying, maybe finally some temptations with yields above 4.6%. Yields moving lower by 5 bips. Euro also finally strengthening versus the dollar, up 0.25%. Dollar has been dominating, especially when it comes to Asian currencies. Again, a little bit of respite today, as has the March higher in crude. Geopolitical concerns, they are real, but at least on the back burner for today, down 1 1/3%. NYMEX crude at $84 a barrel. When it comes to individual stocks, one to watch at the open is Tesla. The automaker is asking shareholders to hold a second vote approving Elon Musk's $56 billion pay package. Bloomberg's Ed Ludlow has more. Hey, Ed.
Good morning, Danny. Tesla is down modestly, a few tenths of a percent, but down all the same, meaning it is declining for a 4th straight day, its longest run of declines since January. We've been waiting for this proxy, and you're right. The two main headlines are, one, that Tesla's board wants investors to go back and vote on that very same 2018 pay package, the same package that the court shot down after an investor complaint. In the proxy itself, Robin Denholm, who is the chair of Tesla's board, criticized the Delaware Chancery Court's decision back in January and actually called out the judge, Kathleen St. Jude McCormick. She accuses the court of second-guessing the investor's decision to approve that package in the first place. So it's an interesting dynamic. Tesla now flat, completely flat, but we'll see where we go over the course of the day. The other decision that the proxy puts to investors is to vote on reincorporating Tesla in the state of Texas from Delaware. We knew that this was something that was on the table, but the devil's in the detail. And what Tesla says in its proxy is that they had set up a committee led by one board member and advisors to have this process in parallel with Musk's pay package so that no one could accuse Tesla of using the issue of moving or incorporating to Texas as leverage in a pay package dispute. And the final piece of context, which I think is important, the stock bouncing around down 0.4%, is remember, Musk has said that if he doesn't have voting control, he will go and work on artificial intelligence elsewhere. And his reasoning is not one of financial gain or wanting to upset investors, simply that he doesn't think he can take the actions needed to do the AI progress he sees as necessary without that voting power. And now we're seeing those actions play out. For what it's worth, behind the scenes, I'm hearing from sources that it's layoffs continue, but the AI and autopilot and FSC teams are pretty much untouched. And that gives you a good sense of where the priorities for this company are right now.
Interesting. Ed, appreciate it. Bloomberg's Ed Ludlow. Let's now turn to the retail sector. The FTC is preparing to block a lawsuit, preparing a lawsuit to block Tapestry's $8.5 billion planned takeover of Capri Holdings. This, according to a person with knowledge of the matter. Tapestry had no immediate comment on the expected suit. Bloomberg's Abigail Doolittle has more. Abby.
This is super interesting, Danny, because the fashion industry is typically not the target of antitrust action, but more recently, the FTC has appeared to be trying to develop the law and new theories of harm from M&A, whereas the DOJ has been going after cases that seem more winnable. Now, this possible lawsuit has been circulating for at least a week in terms of its possibility, and what people are saying it's based on is the fact that in paperwork for these two companies, and of course, Tapestry sells leather goods and other luxury goods under Coach, Kate Spade, and Stuart Weitzman, while Capri controls high-end labels, Michael Kors, Versace, and Jimmy Choo. So the concern would be that this luxury conglomerate would be too big. But the point that the FTC may be working off of is paperwork that they say that in outlet malls that they're pricing that they're each other's main competitors. On the other hand, that is such a small subsector of the overall market that there are some people saying that their case may not win suit. That said, at a recent ABA conference, some sources are saying that lawyers there think that the antitrust lawsuit here, the potential for it, that the FTC may have a good chance of winning. Stay tuned. I'm sure that this one's going to be in the news, Danny.
Okay, and we're happy to have you back to cover all of that development. Abby, thanks so much. Let's turn now to aluminum. Shares of Alcoa moving higher. President Biden is preparing to propose higher tariffs on Chinese steel and aluminum during a visit to Pittsburgh. Katie Greifeld has more. Katie.
Yeah, Alcoa shares currently on the rise after that report. Bloomberg News reporting, of course, that Biden will propose new 25% tariffs on certain Chinese steel and aluminum products as part of that ongoing review. Biden is calling for raising Section 301 tariffs on a wide range of Chinese steel and aluminum, namely those products that currently have 0% or 7.5% tariffs should each be raised to 25%. Now, we're talking about a relatively small segment of the U.S. market here. Imports of Chinese steel and aluminum totaled roughly $1.7 billion last year, but officials said that these tariffs, they're designed to head off an anticipated surge and to safeguard the U.S. market. You can see Alcoa shares currently up about 2.4%. Now, Biden, he's also expected to reiterate that U.S. steel, which is based in Pittsburgh, should remain American-owned. Now, remember, of course, Japanese company Nippon Steel wants to buy U.S. steel for about $14.1 billion, and the United Steelworkers Union, which Biden will speak to on this trip, has opposed that acquisition. You turn to shares right now of U.S. Steel and Cleveland-Cliffs. Shares are higher at the moment, Danny.
Katie, thank you very much. All right, let's now turn to airlines. United is forecasted better than expected profit this quarter, easing concerns over the fallout from Boeing. Isabel Lee has more. Hey, Isabel.
Hey, Danny, investors are definitely liking what they're seeing. Shares are popping to 8.8%. That's the highest intraday gain since January 2023 this year. And to your point, it's really the better than forecast earnings we've gotten. And this really allays concerns that the Boeing aircraft delays and the regulatory pressures are not going to derail or at least risk derailing any of their expansion plans. We have adjusted earnings for the next quarter also looking rosy. They're around 3.75 cents to $4.25. That's higher than the $3.73 estimates. We have Cohen analysts saying that they were encouraged by the results, and we have Seaport saying that the print handily bettered consensus estimates. So the outlook really shows just how challenging the beginning of the year was for United Airlines and for the industry more broadly. We were marked by a series of safety incidents. We had a lot of grounding of some planes and the late delivery of aircraft. But for now, shares are up around 8% year to date, but this is already including the Federal Aviation Administration review. So that has already stunted near-term growth because United Airlines had to really delayed the start of 2 new routes. But today it's a good day. Now shares are up around 9%, Danny.
Maybe a good day for United Air, but maybe not for Boeing as they head to Senate hearings. Isabel, thank you so much. Turning to this broader equity market, Bank of America is out with its latest fund manager survey, writing that, quote, it's the most bullish survey since January of 2022, the biggest jump in global growth optimism since May 2020, a record jump in allocation to commodities. Risk assets tactically are much more vulnerable to bad news than good. Joining me now is Gina Martin-Adams of Bloomberg Intelligence. Gina, so great to see you this morning.
Thank you.
Okay, so I know this is a little bit awkward to talk about this after a sell-off, about everyone being so optimistic, but is there a degree where positioning looks overly stretched now?
Yeah, well, we did end the first quarter with positioning somewhat overly stretched, and we see that most evidenced through correlations. Correlations on the S&P 500 as well as on the global indices reached the lowest levels that we'd seen since 2019. They're more than a standard deviation below long-term averages. Usually when you see pairwise correlations in the market at such low levels, it does indicate a degree of bullishness. When we look at our broader sentiment indicators from the market itself, though, and again, we're not analyzing what people say, but really what they do, the market itself looked somewhat closer to neutral. So I do think that a lot of it is concentrated in the biggest of the big caps globally as opposed to small caps in all equities, and that's an important clarification to make in terms of where bullishness really is in the most defensive components of the equity market still. which is interesting because normally if you see overly bullish sentiment, it would be in small caps, it would be in EM, everybody would be all in. That's definitely not the case just yet, according to our work.
So if more of the all-in aspect is coming from big tech, what happens when we get their earnings? It's due next week. They're projected to lead profit growth in the S&P 500. How much is riding on that?
A lot. Unfortunately, a good deal is riding on it. We are already seeing, though, rotation in the equity market. We follow 30 different themes in our thematic universes work in Bloomberg Intelligence. Of those themes, AI has actually fallen to 5th on year to date in terms of performance. So you've already started to see over the course of the last several weeks some of the AI themes lose a little bit of momentum. Tech certainly has been showing some topping patterns, reached a magic valuation level. Big cap tech tends to top at about 28 times earnings. We reached that again, and the sector shows a little bit of topping activity, at least in the short run. So some of that sort of steam, if you will, already has been released from the tech sector. That doesn't mean there's not still a lot of pressure on earnings. This is a group that is expected to definitely post the strongest earnings growth among the S&P 500 companies. In particular, the top stocks in the S&P are still expected to lead the rest. Though I will say that is not the embedded expectation going forward. This is supposed to be basically peak growth. So there is pressure on the rest of the index as well, not necessarily to perform in the fourth quarter report, but to guide us to say things are going to get better for the rest of the year. So the pressure's on for all companies to generally put up some decent numbers for Q1 and really guide us to expect better times ahead.
Well, the most recent sell-off feels like the underpinnings is more of higher yields than earnings, but this next leg of higher yields, is it really the type that can do damage to equities if it is predicated on a strong U.S. economy, and that's why yields are going higher?
I think that's a really, really important point to make, is if what we're seeing is yields are selling off because growth conditions are improving, and that means the demand outlook is improving, that's not necessarily embedded in expectations right now. When we look at the earnings growth numbers, really what analysts are anticipating is much better margin growth from companies. So they're anticipating a slowdown in inflation pressures. They're anticipating some margin improvement to emerge throughout the rest of this year. Top line growth is not anticipated to improve. There's very, very grim expectations, in fact, I think perpetuated by macro forecasts on the earnings outlook. So if we're getting growth beats, and that's resulting in higher for longer interest rates, that actually could be quite a good thing for equities.
Right, they're still consumers, they're still spending, they're helping corporates have profits. What about the argument, though, that says, well, higher yields mean my equity risk premium shrinks, and they're less attractive to bonds?
So the equity risk premium already has shrunk. The equity risk premium is at its lowest level in 20 years. I think the equity risk premium is a bit overstated for its tactical benefits. It's more of a secular story and a long-term story, but the equity risk premium was negative throughout most of the 80s and 90s. You're talking 2 decades of negative equity risk premium. So there's not a lot to say about the risk premium being low. It's just lower than it has been in the last 20 years, and I think that reflects a big inflation regime shift. Most of the last 20 years, stocks and bond yields were positively correlated because inflation was viewed as a generally good thing and reflective of demand conditions. Now we're in a different inflation regime. Inflation could be viewed as supply constraints emerging, creating some margin pressures for the S&P 500. The results of that is you need to pay attention to the equity risk premium, but it's not necessarily your guiding light with respect to allocation.
What about the attractiveness of cash? Because there was a narrative that there was so much in cash that's going to flow out, that's going to go into risk assets. Presumably, if we are higher for longer, that story is getting delayed.
Yeah. So generally what you find in an allocation is equity is not a substitute for cash. Cash is not a substitute for equity, so that's an important thing to consider. That said, certainly there are other alternatives to equities, which is a very different landscape than we've been in since the great financial crisis. Low interest rates have forced investors to add to equity exposure in order to seek some form of return, even in some cases, some yield.
Right.
Now we have other opportunities, other options, and in a diversified portfolio, equities aren't necessarily your best option for in a lot of instances. That said, you buy equities for growth, you buy cash for yield.
And I was going to say, I guess the irony of me asking that question as I was saying it, I kind of realized that's also a good thing for companies who have all of this cash in their balance sheet that are putting it to work.
Yes, I think this is one of the underappreciated aspects of Q1, and this is something we've talked about a lot, is throughout this earnings season, something we're definitely looking for is a potential sign of a recovery in capital deployment, in particular buybacks. Buybacks were very constrained in 2022 and 2023 as the companies really suffered with contracting cash flow. Now that cash flow has started to recover, we're anticipating at least some degree of improvement in buybacks and improvement in capital deployment strategies in general. We're looking for signs of CapEx. So we should start to see that momentum improve for capital deployment over the course of Q1 earnings announcements.
Right. Gina, afraid that's all we have time for. Always a pleasure to speak with you. Gina Martin-Adams there of Bloomberg Intelligence. Coming up, Boeing under fire on Capitol Hill.
You have had this management overhaul in place and the board changing as well. I do think it is a little bit of either. There was the NTSB with the Senate yesterday. We didn't learn anything really new.
Boeing's safety record in the spotlight. That conversation up next. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal. That deal. The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
What happened was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
This is Bloomberg.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a 3
as the economic picture.
covering the intersections of Hollywood, Silicon Valley, and beyond.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
You have had this management overhaul in place and the board changing as well. I do think it is a little bit of either. There was the NTSB with the Senate yesterday. We didn't learn anything really new out of it, whether what happened on the Alaska flight or Boeing safety culture. So I'll wait to see what happens today. But given that there's no Boeing executives, I don't think we'll hear much new.
Boeing safety and culture in focus on Capitol Hill. 2 congressional hearings taking place today. Lawmakers are set to question the safety experts and a whistleblower. The Senate Permanent Subcommittee on Investigations chair saying, quote, the public has a right to know how a once preeminent company with tremendous credibility has really seen its reputation shredded. I think we can guess how that reputation was shredded. Joining us now is Bloomberg's Sid Phillips. Sid, as if it wasn't just one Senate hearing that Boeing had to contest with, it is two separate ones. Of course, Boeing officials won't be present there. So what are we likely to hear?
Morning, Danny. So there's two separate sessions. The first is going to examine the safety culture at Boeing, and that sort of promises to be a sort of retrospective about the various practices that experts in a report that was published last month by the FAA are sort of recounting the issues that Boeing has and the challenges it's had in terms of safety. And that was sort of, that report predates the blowout of the door plug on January 5th. So that's going to be an interesting hearing. And then an hour later, we're going to hear from a whistleblower who says that the 787 is unsafe, and he sort of pointed out that structural issues with the 787 make the plane unsafe. And that's really going to be an interesting testimony as well, because the whistleblower hasn't really made clear what his sort of basis is, other than the fact that he worked as a quality engineer at Boeing. And we're hoping to see if we can sort of see any more than that. Boeing's pushed back against the whistleblower claims. They've said that the issues that he's raised have been addressed in the prolonged groundings that they had for the aircraft in the start of this decade. So it's going to be really interesting to see how Boeing sort of responds to those allegations, both on the safety culture as well as on the whistleblower.
Has Boeing said anything about these hearings yet? Because as I said they're not going to be there.
Yeah, Boeing's not going to be at the event, so we haven't really heard much from them about specifically about the hearings. I mean, they have disputed the account of the whistleblower, saying that they've done various tests to make sure that the planes are safe. But at the same time, we haven't really seen much more from them. So expect more from Boeing, even though they're not going to be on Capitol Hill this morning.
But, okay, if they're not going to be there, we're hearing from whistleblowers. We kind of know what we do know what they're going to say. You just laid that out for us, Sid. Does this change anything for Boeing, having these twin Senate hearings?
It just adds the pressure onto Boeing. I mean, Boeing, as you mentioned previously, Boeing is in the midst of a massive change. The CEO, Dave Calhoun, has said he's going to step down at the end of the year. The chairman has already stepped down, and they've replaced the head of the Boeing commercial airplane division. So they're in a bit of a flux at the moment. This is a really important time for them. They've sort of promised to get things right and fix their issues that have been structural in terms of quality and safety of aircraft. And so this is just going to add more pressure onto Boeing at a time when they're already under tremendous pressure from regulators, airlines, and the general public.
Sid, appreciate it. Sid Phillip there. Now, let's get some of the sector price action this morning and head on over to Bloomberg's Abigail Doolittle. Hi, Abby.
Hi, Danny. So for the first time in 4 days, we are looking at the possibility of an up day. That said, we've had a couple of reversals from early gains, so let's see whether these gains do hold. Right now, sector-wise, we have 10 of the 11 sectors higher, led by materials up about 0.9%. Utilities up about that much, some relief as yields are down for those dividends. Real estate, interestingly, is still down, even with that relief. Let's check in on the S&P 500 apparel index, because we were talking earlier about the possibility of that antitrust litigation suit to be brought by the FTC against Tapestry and the Capri deal. Even so, over the last 2 days, this sector up 1.7%. Most members of this index today are higher, including Tapestry. On the other hand, Capri is down, not surprisingly, if folks think that there's a possibility that deal might not go through. But again, the bulls are out this morning overall. Something to cheer, Danny.
All right, Abby, thank you very much. Speaking of the bulls, airline stocks are also higher after United earnings that we've been talking about today. It is the biggest jump since January. Okay, coming up, we're going to look at some of the market-moving events you need to be watching. That's all next in our trading diary. This is Bloomberg.
Today, I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
Underperforming this morning, up just 0.1% here in just 30 minutes of trading. It is small caps that are leading the way. Yields are also calming down after heading to highs of the years. So is the repricing over, or is this just a pause? This was the countdown to the open. This is Bloomberg.
In global leadership are on Bloomberg.
The ultimate goal of doing away with the central bank still stands. The discussion regarding the central bank is primarily moral in nature. The way we see it, there has been a cultural change in Argentina. Today, wages are miserable. Not through our own fault. That is due to 20 years of populism. Argentines have understood that populism is no solution, and that the quick fixes they sold to them during the last 100 years, both the criminal politicians and criminal economists, they were all false. And we need to opt for a pure orthodox market-based solution. And that's what's going to make us succeed. And that's what's underway. In fact, there are already indicators today that show that activity in the agriculture sector, in the oil and gas sector, in mining, well, our economy is recovering strongly in those departments. There are indicators that point to the fact that Argentina could really make a strong comeback.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. This is Bloomberg Intelligence with Alex Steele and Paul Sweeney.
The real outperformance has been the U.S. corporate high yield.
Are the companies lean enough? Have they trimmed all the fat?
The semiconductor business is a really cyclical business.
Breaking market headlines and corporate news from across the globe.
Do investors like the M&A that we've seen?
These are two big-time blue-chip companies.
The window between the peak and cut changing super fast.
Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
Good Wednesday morning from the Bloomberg New Energy Finance Conference in Midtown Manhattan. Leaders in the energy and new energy space, they come together to discuss the transition to a more sustainable energy industry. On the program today, we will bring you live interviews from this conference with some of the leaders in the industry. Of course, we will also bring you the latest on market news, what's happening in the industry, what's happening in markets. We have some green on the screen here this morning. So a fun-filled day, action-packed, focusing on the sustainability of new energy going forward. But first, let's go to Lisa Mateo and get a Bloomberg Business Flash. Lisa, what do you have for us?
Good morning, and Market Drivers brought to you by Interactive Brokers. Discover the future of trading with their next generation trading platform, IBKR Desktop. Download IBKR Desktop at ibkr.com/desktop. All right, we've got green on the screen after the major averages closed mixed in Tuesday trading, and that came after more Fed speak. Chair Jay Powell, who once again said that interest rates will likely be higher for longer. Now, the Federal Reserve's latest beige book summary, that comes out later this afternoon. Some news on the housing front, too. U.S. mortgage rates climbed to a 4-month high last week. The contract rate on a 30-year fixed mortgage rose 12 basis points to get this 7.13%. That's according to the Mortgage Bankers Association. So right now we have the Dow up 0.3%, the S&P 500 up 0.2%, the NASDAQ up 0.1% or 22 points. The 2-year yield at 4.95%, that's down 3 basis points. The 10-year yield at 4.63%, that's down 3 basis points. And over to commodities, we have spot gold higher at $2,390 an ounce, and oil, Brent crude, $89 a barrel. That is your Bloomberg Business Flash. Paul and Alex.
All right, thank you so much, Lisa Mateo. Sorry, Paul, about that 30-year mortgage there.
Yes, thank you. Well, it's all right.
No
I'm
refi
sitting
for
at
you,
6%. I thought I was a chump when I underwrote that mortgage. Now I feel a little bit better.
You should feel better. That's
a little bit better.
6 feels solid.
6 feels solid. It's the new 4, I think.
6 is the new 4?
Yes.
I like this.
Yes.
I like this very much. Okay, so I was on stage. I was doing
I know,
things.
you were doing things. I was watching. You were interviewing some new energy people, right?
And we'll talk to them, actually, on the radio program from Chevron and Shell. But what did I miss? Like, what's going on? What are we doing?
I don't know. A little bit here, a little bit of a lift here in the marketplace. Just trying not to see. You got the S&P, as Lisa was just reporting, up 0.25% here. But we're smack in the middle of earnings here. So that's going to be driving the show, I think, really for the next couple of weeks here. It looks like the Fed, we heard from Fed Chairman Jay Powell yesterday, he's okay with higher for longer. I think that's the takeaway there. And the market seemed to take that in stride yesterday, I thought.
Yeah, really? I mean, we hit that 5% in the 2-year, and then we kind of backed off, and equities didn't do that much. I wonder now if it goes to earnings, like, will a higher for longer actually dent margins and profits? Or if you can deliver, then why wouldn't you buy equities?
Exactly. Gina Martin-Adams, Bloomberg Intelligence, she says earnings are going to come in actually a little bit better than expected for 2024, driven primarily by revenue growth. So we'll see how that plays out. But again, we're just kind of right in the beginning of the S&P 500 earnings season.
Just to hit this headline, U.S. Will reimpose Venezuelan oil ban unless President Maduro acts quickly. So basically the deal here is that tomorrow the ability for Venezuela to export crude, that ends. So now the Biden administration can do something about it. They let that export ban roll off in order to ensure free elections in Venezuela. So that's what it means by unless he kind of shapes up and does his part.
Brent crude here today, Alex, off about 0.9%, $89.20 a barrel for Brent crude.
All right, let's get more to the markets here. Abigail Doolittle, a Bloomberg News markets reporter, joining us now. All right, Abigail, talk to me about what you're looking at right now.
I'm looking at the possibility, Alex, that we may see today what we've seen over the last couple of days, and that is a stock market that starts out higher and then finishes lower, or at least goes lower at one point during the day. Earlier, the S&P 500 had been up about 0.4 or 0.5%. Right now, it's up just 0.1 0.1%, and the NASDAQ 100 is down 0.1% after having been higher. So that tells me before I even look that it's likely technology, those big tech heavyweight drags, the point movers on the S&P 500 and the NASDAQ that's moving the needle. And it's actually a piece of the needle. It's NVIDIA and Tesla. Both of those stocks are down. Those are the two biggest drags on the S&P 500. Meta is also there. On the other hand, you do have Alphabet higher, the top point boost for the S&P 500, Eli Lilly, United Health, Microsoft and Apple are also over on the other side. But with NVIDIA and Tesla down sharply, it seems like that's where we're having the possibility of yet another bearish reversal, although it's too soon to say that for sure.
Hey, Abigail, you know, when I saw the news yesterday afternoon of Fed Chairman Jay Powell's comments about rates, I really thought that we see the equity market sell off. We did not. What does that tell you?
Sometimes the markets do for the Fed ahead of or thereabouts after. Sometimes the markets really do the work for the Fed. So I think that maybe his comments were anticipated by the big move up that we've seen in yields. I think at the end of the day, it's going to come down to fresh data. And of course, that beige book, at least I believe the beige book data comes out later today. So everybody will be scouring that. I wouldn't be surprised. Does it come out today, Alex?
It does, yes.
Yes, and so I think that we'll probably have a market on hold to some degree around that, treading water to see if there's any more thought on the trajectory for rates and inflation ahead there.
What stocks are popping today? Not literally popping, but like popping for Abigail.
What stands out to me, really, this is very, very interesting, is the possibility of the FTC blocking the Tapestry and Capri deal. That, of course, would be a luxury fashion conglomerate here in the U.S. The reason it's so interesting is that fashion is typically not in the antitrust area. It also tells us that the FTC is taking a much different approach to this law than the DOJ, which typically is going after cases of winning, whereas the FTC appears to be shaping the law, and especially around harm having to do with M&A. Apparently, if their case goes through, because we don't know that they are going to actually file this lawsuit to block that possible deal, that $8.5 billion deal, it would have to do with outlet malls. There's a lot of paperwork between these two companies pointing to the fact that they view each other as their main competitors. But the argument against that would be that malls, that the outlet malls, it's too small of an area of the overall retail area to really be antitrust. So it's really unclear if this lawsuit goes through whether or not they would win. But that's really interesting. And at this point, we do have Capri down because, of course, if the deal didn't go through, that would not be good for them. And Tapestry, last time I looked, was higher, and it still is, just ever so fractionally.
We're getting, kind of right into the meat of earnings here. Abigail, what are you looking for here this earnings season? What do you think the market is kind of discounting?
Well, it's going to be all about big tech, whether or not these companies can deliver on what's expected. Now, it's interesting because the growth there is strong relative to so many other companies. But on the other hand, I'm guessing that both of you, if we were having this conversation 5-10 years ago, we'd be talking about very solid double-digit growth for any of these companies. For some reason, I'm thinking of Google in particular. So I'm just going to happen to pull up that FA, financial analysis function on in the Bloomberg terminal. 8.7% growth for this year. That's not even the quarter. So the growth has really slowed. Will they be able to match those estimates, these companies, these big tech companies? And if not, then you're going to have not just a rates problem, but you could also have the big point drags or the big point contributors to the S&P 500 and the NASDAQ under some pressure if earnings are disappointing.
All right, Abigail, thank you so much. We appreciate it. As always, Abigail Doolittle, she covers all the markets for Bloomberg. George Ferguson, he covers the aerospace and the airlines companies for Bloomberg Intelligence. He's always globe-trotting around the world to all these great conferences. There's in Paris, London, Miami. They're never in Peoria. They're never in Cleveland.
This is like
February.
a bitter moment for you.
This is a bitter moment for me because I ended up, for many years, I paid for these trips for George, and I always did it grudgingly. Today he's from Arizona. I assume he's out there in the desert looking at these planes that they have to maybe take out of mothballs and put back in the air. George, thanks so much for joining us here. I mean, aren't there a lot of planes out in the desert in Arizona that the airlines can just kind of polish up and put back in the air? Do they need Boeing that much?
So there aren't a lot of planes in the desert. I think most of the airlines are flying what they have. I will say when we landed at Tucson yesterday, I did see some older United and Delta airplanes parked over on the ramp. So I guess there's a couple of these out here, but we're talking executive aviation out here this week. These are private jet. This is a private jet discussion.
Of course you are. Of course you are.
You need that. You need the private jet discussion.
Yeah, and Bloomberg Intelligence, I don't recall me authorizing a private jet, but maybe I did for George back in the day.
Maybe you did. Maybe he just put it there and you signed it, and that was it.
Exactly.
A lot to get through actually in your space. Can we just hit on United for a second? Because that stock is up over 11%. I was there when the earnings broke yesterday on set for TV, and man, those are really strong numbers. What surprised you the most out of their strength?
Yeah, I think there were pretty good numbers, and I like to look at things more like a glass half empty, but it was really hard to do in that result. What stood out to me actually was a lot of strength in Europe. I think yields to Europe were up some 7%. Delta didn't show that kind of strength. And then the domestic yields, right? Yields are the price a passenger pays per mile they fly. Domestic yields were up, I think it was close to 3%. Delta was flattish on that. So I think better performance in their domestic business as well. United is in the middle of catching up to Delta. They're adding a bunch of airplanes to their fleet, so this is where Boeing does come into play. They're adding airplanes to their fleet that they're largely using on domestic routes, which help them add premium seating. And I think some of those efforts showed yesterday. I think as they're able to put more big payers in the front of the airplanes and do better on fares.
George, how much of the United and just the U.S. airline business, where are we in terms of the business traveler coming back? Because I know that's kind of where the big margin is on a per seat basis. Where are we in that context?
Yeah. So my sense is we're still probably 10% down compared to where we were in 2019. I didn't see much in United's disclosure yesterday. They talked about double-digit increases, but we want to hear an absolute number. We'll listen closely today. That is a drag for the big full-service carriers, Delta, United, American. They have been making it up with premium travelers. I flew into Tucson yesterday on a smaller Embraer airplane, a 175. The front of that had premium seating in it, right? It was a United flight. They're trying to provide premium seating into every market. It helps them upsell, gives them better pricing. But I still think we're about 10% down on that metric, and it's a tailwind. It's a headwind, which could turn into a tailwind if we start to see business rebound even more. But it's been a while since the pandemic, but we've been waiting for this to turn around all the way.
I'm going on vacation on Friday, and I'm flying economy, and then
Are you in the back of the plane?
I'm in back of the plane. But my daughter was like, "Mommy, what class are we in?" I was like, "Okay, this is not a good sign. This is not good parenting."
Exactly.
Hey, George. Also, what was interesting is we get Boeing. I know. We get Boeing whistleblower testifying to Congress today. What are we gonna learn? Like, the headlines are really interesting. The headlines are gonna be sexy, but like, what are we gonna learn that we don't already know?
Yeah, so I don't hold a lot of hope for congressional hearings and learning a lot of good information. I sense there'll be a bunch of grandstanding. We know there are members of Congress that aren't happy with Boeing. I'd really like to see what comes out of the FAA investigation of the whistleblower. That will matter more to us. This is a problem that I think has already been visited on the 787. There was a shim issue, a couple of years ago. Boeing dealt with the FAA on. So I don't hold a lot of hope that we're going to get a lot of good information out of Congress today.
But I guess if I'm an investor in Boeing, George, I guess to me it's all about the deliveries. And where are we in terms of deliveries today versus where I guess?
So I think that's the million-dollar question. We didn't see very good deliveries in March. And, we got one of the news we got out of United was they were cutting their deliveries by about 40%. We've already heard sort of discussion that Reuters has got information from Southwest that they're cutting their expectations 50%. So that's the big question right now. It looks like Boeing deliveries for the year expectations probably need to come down. I don't know if they're 50% though of what we thought, 400 airplanes, 737s, but they probably have to come down.
All right, aviation geek question. I just Googled the historic aviation boneyard. That's in Tucson. I mean, there are planes parked there as far as the eye can see.
Yeah.
Why are they there? I mean, did they ever expect to be brought back into service? Why don't they just scrap these planes? Why is there an aviation boneyard with literally thousands of airplanes parked right next to each other?
It's because this is the perfect place to park an airplane that you're not sure if you'll need one day. So Southern Arizona, hot, very low humidity, and that keeps airplanes from deteriorating. That's why they love to park here. The military has a very big boneyard out of Davis-Monthan Air Force Base, and then there's a bunch of civilian boneyards around here in Arizona and in Southern California. So this is the place for old airplanes.
So Paul's showing me a picture right now on his phone, and for those of you on radio, it's really cool.
I mean,
you
there's
should
only
definitely check
thousands
it
of
out.
these planes.
I don't think I've ever seen anything like that before.
Are you going to go there, George, to the historic aviation boneyard?
So every time I'm in Tucson, I have to stop by it because there's also the Pima Air and Space Museum. We'll give them a little plug. It's got an SR-71 Blackbird, the fastest reconnaissance airplane ever. Although there's probably a successor to it we don't know about, sitting out there under an awning. So you got to go there. You got to pay homage. This is where the B-52s, those kind of airplanes are all sitting around. It's a history lesson in aviation.
Very cool.
So for me, it would be like walking around like old rigs that don't move anymore.
Oil rigs, right?
Yeah,
yes,
and
okay.
then for him, the planes. But like, what do you do? Like a graveyard of cord cutting? Like, what would you walk
what
around?
do I do as a media guy? I go to Hollywood.
You just walk around Hollywood and then just be sad.
Exactly.
Just real quick, George, before I let you go, I understand you're not going to expect a lot from Boeing, but like, do the headlines just need to stop being bad in order for investors to get a little bit more comfortable?
Yeah, I mean, for sure, Boeing would prefer this not to happen, right? So we would like, I think, if you're an investor in Boeing, to see, less of these headlines. The whistleblowers, there's lots of whistleblowers coming out. Some of them may have some credence, many of them probably don't. It's going to be a little while, I think, before the headlines turn for Boeing.
All right, George, thanks so much. We appreciate it. Head out there to the Boneyard Museum, the Pima Air and Space Museum, also there in Tucson. I'm just kind of looking at my Google map here. Lots of cool stuff to do in Tucson. Tucson Mountain Park, all kinds of cool stuff there. Tucson Botanical Gardens. I feel like check that
Cactus?
out. Probably cacti.
Mm-hmm.
George Ferguson, he's the aerospace airlines analyst for Bloomberg Intelligence. Tucson. So you were hosting a panel, Alex, literally right before this program. What was the panel about?
So the panel was about how basically big energy companies are dealing with the transition. So I was speaking with Anna Moskalo.